heaven, because Lisa's kids are going to get in touch now. That's it. The trouble. You had to leave again.
Yeah, they're going to basically say,
Brammo's boys want to come to the UK with us if we go to the UK next time.
They'll be sitting on set with us.
That's the change.
Well-behaved lads.
Not happening.
He did once sit on set with me.
I know, he did. He told you about Apple.
Live on Bloomberg Radio and talked about Apple, and he was fantastic. Rivaling Dan Ives. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The sell-off in the UK assets has gone into overdrive. The pound plunged to an all-time low before rebounding, and government bonds were slammed. Now there are calls for aggressive rate hikes by the Bank of England. The latest tumble was fueled by Chancellor Kwasi Kwarteng's comment on Sunday that there's more to come on tax cuts. In China, the Communist Party has reaffirmed President Xi Jinping as its core. The party published its list of almost 2,300 delegates to attend next month's leadership summit. The announcement brings Xi to a step closer to clinching an unprecedented third term in power at the event. The Philippines is talking to Russia about buying fuel and other key commodities. President Ferdinand Marcos Jr. told Bloomberg TV that national interest overrides concerns about the war in Ukraine.
Now maybe we need to approach Russia, that maybe they can loosen up and provide us with some fuel.
Marcos says the Philippines is close to reaching deals with Russia and other countries. And the CEO of Unilever plans to retire at the end of 2023 after only 5 years on the job. Alan Jope presided over a tumultuous period where the consumer goods company botched a potential $53 billion deal and irked investors with lackluster growth. Unilever's board says it's starting a search for Jope's successor. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What's happening on Wall Street?
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Be PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
I think the UK is behaving a bit like an emerging market turning itself into a submerging market. It would not surprise me if the pound eventually gets below $1 if the current policy path is maintained.
I'm sure that sounded like a big call at one point on Friday. Then this morning, 103.50, we came pretty close. That was Larry Summers, the former U.S. Treasury Secretary, live from New York. Good morning. Equities down 0.6 on the S&P. On the Nasdaq, we're down about 0.5%. Not really the drama-filled morning on the equity side you might expect, given what's happening in the bond market. Up 7 or 8 basis points on a 10-year, 3.76. Dollar strength, the dominant story in foreign exchange through the year so far. Euro dollar 96.51. And pound sterling, 5 straight sessions of weakness over those 5 days. Cable is negative 6 percentage points. Tom, a weak pound over the last week.
What we're trying to do on our team worked all through the weekend, given the turmoil, to give you the voices that matter. And of course, a cross-section here of strategists, economists, and even with a political bent, of course, Lizzie up with the Labour Party at their effort in Liverpool. Right now from Goldman Sachs, their co-head of global foreign exchange, interest rates, and EM strategy, Kamchatka Trivedi, joins us this morning. Dr. Trivedi, wonderful to speak to you this morning. And I think I want to go to what the politicians need to do to avert the tumult in your world. How do we get from Trussonomics 1, a la Reaganomics 1, out to Trussonomics 2, or Reaganomics 2, which was tax increases and a pullback? How do we get there?
Yeah, good morning. That parallel is interesting. I mean, I think you mentioned Reaganomics, at that time as well, you had, in massive tax cuts, which encouraged already high inflation. But there were two important differences. The dollar, is a reserve currency. It has that exorbitant privilege. But you also had the Fed under Chairman Volcker, who, clearly moved interest rates very high to bring down inflation. And even with those benefits, as you mentioned, Reagan Mark II was, you had some of those tax cuts partially reversed. And so I think you're going to need to see some combination of this to stabilize what is going on in currency markets, what is going on in the pound specifically. Some communication that emphasizes the fact that fiscal credibility is not at risk, and monetary policy will be firmly targeted at bringing inflation down over the medium to short horizons.
Kamchatka, I want to pick up on that in the UK specifically. Do we have a recipe for a self-fulfilling downward spiral if we don't have the foreign currency debt ingredient present in the UK gilt market?
I think you're right. I mean, I think I heard some of the, I hear some of these comparisons with emerging markets. I think they're very unhelpful comparisons, not least because most EM currencies have not fallen as much as the pound this year, but also because, the UK does not have, as you mentioned, foreign currency denominated debt. It has a very long maturity of its debt in terms of the overall public debt burden. And so, the concern here is not so much that the UK cannot service its debt. That's not really the issue. I think the concern is more whether the package announced, broad fiscal spending, unfunded, not particularly targeted, will, add to the inflation, lead to sort of more gilts that need to be issued, and that requires a cheapening of gilts. That is partly what is going on in the market, both through gilts actually selling off, but also through the currency depreciating. So the moves are extreme, but they are explainable.
Kamakshi, a lot of people are talking about a currency crisis brewing, unlike what we have seen in decades. And people point to what's happening in the United Kingdom. But even more around the corners, they're pointing to what's happening over in Asia with respect to the yen, with respect to the Chinese renminbi. How concerned are you about that area and the willingness to really stage some sort of intervention at a time when the UK doesn't really have the foreign currency reserves to even stage an intervention if they wanted to?
I think there are some different issues. I mean, you're right, the broad North Asia complex is also moving, but I'd say there's 2 or 3 differences. First, yes, we are in the midst of a broad dollar move. We expect the dollar to continue to weaken, and that's taking a lot of currencies, with it. Yen and yuan are part of that. But, look, in the case of yen, the Bank of Japan has an explicit policy to keep yields fixed even as they go up in the rest of the world, in particular the US. In the case of China, the economic struggles that the economy is facing means that they're actually lowering or easing interest rates as part of their easing financial conditions mix. And again, you compare that to a Fed that is relatively unconstrained in terms of moving rates higher and has a steady growth backdrop. When you put those 2 things together, it shouldn't be a huge surprise to see these currencies weaken. Of course, the policymakers typically don't like the speed at which these things happen. And so you've seen the intervention in the yen, you've seen, measures to slow the pace of the yuan depreciation. But ultimately, I think, for a kind of meaningful or sustained shift in these trends, you actually need a shift in the policy framework. And that's not something that we expect.
But Kamakshi, I guess the bigger way to ask this is, at what point do some of the moves, whether it's in the United Kingdom or whether it's in Asia, become a trigger point for something larger that the Fed has to respond to?
Look, I think that, one of the issues right now is that the stronger dollar is actually, helping the Fed with what is its high inflation problem. To the extent that they are very focused on the inflation remit and bringing inflation down, the stronger dollar is on the margin helping from that standpoint. So I think that, at least as far as that is concerned, I don't think the strong dollar will be bothering them. I think at some point, if you really see the strong dollar, but alongside that, significant weakening in the domestic economy, or, what would be a better outcome if inflation starts to peak and come down, I think that is the point at which the Fed starts to care about this. For now, I suspect they're still very focused on their inflation mandate. And I think, the combination of steady growth and large Fed hikes is going to be hard for a lot of people across the world to match.
It's difficult right now. Kamakshi, as always, sir, great to catch up. Kamakshi Trivedi there of Goldman Sachs. This from Mike Wilson of Morgan Stanley this morning. Here's the quote on the US dollar. The recent moves in the US dollar creates an untenable situation for risk assets that historically has ended in a financial or economic crisis or both. And Tom, they put on a rolling year-over-year chart of the US dollar, up something like 20% or so over the last year. Yeah, and all the different crises over the last, few decades off the back of it.
Well, Carl Weinberg was mesmerizing on us. He lived this, John, with Ecuador and a bunch of South American economies here in the 90s and the 80s. And all I can say, John, is we're becoming overcome by events. We don't need to get mathy on it. We don't need to turn it into a chartathon, other than to say we're committed, folks, and not just showing you pound sterling against a dollar, against a euro. This is much more, and John, this is much, much richer, starting, for example, with Korean won.
Futures, Tom, we're down 0.6% on the S&P. On the Nasdaq, we're down 0.4%. Yields are higher by 8 basis points on a 10-year, 3.76% on a US 10-year. Live from New York City with Tom Keene, Lisa Abramovitz and Jonathan Ferro. Phil Camporelli of JP Morgan joining us very shortly. Heard on radio, seen on TV. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Uncertainty really is approaching those critical levels.
The uncertainty is something that just continues to weigh on markets.
The Fed message is clear that they cannot and will not wait for the supply side to move favorably, that they're acting aggressively now.
We still expect the Fed to moderate the pace of hikes once it becomes clear that the labor market is beginning to topple over.
Stop looking for the Fed to be your friend. Stop looking for Powell to say something conciliatory. He's not.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Yields up, stocks down, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down 7/10 on the S&P. TK, this dollar still climbing.
The dollar's still climbing, and to be sure here, folks, this is not just about John's United Kingdom. It's about a disunited emerging markets all reacting to this. It's in every pair globally. We'll commit to that today, John. And what it means is you've got to look for the shocks there along this path.
Global bond yields, TK, what a shocker. 13 consecutive days of 2-year yields climbing, 8 consecutive weeks of 10-year Treasury yields climbing into this one. Could it become 9? Tom, the last time we had a down week on a 10-year yield was back in late July, and the yield was 265. Right now, 377.
So how do you distill this? And the answer, folks, is you watch The Real Yield Friday afternoons on Bloomberg and through the weekend with Jonathan Farrow. What the pros are doing, John, is they're distilling the bond FX correlation down to a real yield analysis. And in the United States, the real yield, the inflation-adjusted yield, is a moonshot.
Bloomberg Real Yield is no longer with me because I keep failing to turn up for work. It's now with Lisa Abramowitz. Weekdays, Fridays, it's not. She really doesn't want it to be. Although she could be. It could be with you, Lisa, if you want it to be.
You never asked me.
You change your mind, you know, let us know.
Look at this market.
Look at those markets.
I mean,
what a
right
move in a global bond market. We've just blown up a decade worth of zero interest rates, negative rates worldwide.
And this is having real consequences on the real yield equation. And we heard this from Russ Kostrich of BlackRock earlier, that suddenly you're actually getting income. And we keep talking about this. But when we take a look at the 10-year inflation-adjusted yield at nearly 1.4%, John, based on the decade or so of zero or negative real rates, this all of a sudden is offering an attractive opposition to potentially risk, like stocks.
Are you waiting to see if anyone comes out and downgrades their forecasts on the S&P? Because I am.
We've already seen it. And how much further does it have to go? And what's the rationale going to be? And this is going to be a really interesting aspect of it. Is it because of shrinking margins? Is it because of global growth deteriorating? Or is it because there just isn't the same kind of consumer demand at a time of hiking rates? This will be the most interesting part to me.
John, the VIX 32.41, and none of that without catharsis. We're just sort of there from a 28 out to 31, 32, 2.53 points this morning. That doesn't show me the sweat, the emotion you need.
JP Morgan's still at 4,800. Just pencil that one in. We should hear from them a little bit later on this afternoon. And we'll see if we finally get that kind of capitulation, because, Lisa, there are still some holdouts right now. There are still some holdouts.
Do you think that if they have some capitulation, you're talking about Marko Kalanovic, maybe?
I'm suggesting
perhaps?
maybe he might be publishing at lunchtime today.
So
we'll see.
If he does, and if he says, you know what, I've been wrong. I've been really wrong. I'm now bearish. How many people say, all right, back up the truck?
There'll be a line full of people saying that.
Yes, 100%.
Just the debate at the moment. Futures down 0.8 on the S&P. On the Nasdaq, we're down about 0.6%. Yields higher on a 10-year by 9 basis points, 377.88. It's not just about sterling weakness. Dollar strength is so powerful this year. Euro dollar 96.38. Lisa, that currency pair negative 0.5%.
This very much is the energy story. This very much is the inflation story. This very much is the strength of the U.S. and the Fed versus the ECB. But it's also a political story, and increasingly so. Today, French President Emmanuel Macron plans to present a budget to Parliament. How much does he try to offset some of the higher energy prices of consumers in France? This really goes to the political question of the moment, which is, what is the response, and how does that really rebound into growth? Do you prioritize bringing inflation down? Do you prioritize supporting households, or do you prioritize growth? Can you have your cake and eat it too? The market is saying no. Right now, also at 9 a.m., ECB's Christine Lagarde will be speaking before European Parliament in Brussels. How much is she committed to trying to narrow the gap in yields from the peripheral regions and the core? How much do you get this sense that they are committed to offsetting the potentially outsized rate hikes that they are all but committing to? And today, there will be a host at Fed Speak. It is back. Boston Fed President Susan Collins at 10 a.m., Atlanta Fed President Raphael Bostic at around noon, Dallas Fed President Lori Logan at 12:30 p.m., Cleveland Loretta Mester at 4 p.m. Do they talk about the dollar, John? How concerned are they about weakness in the rest of the world as a ramification of very hawkish Fed policy?
Do you remember when we all turned to former Vice Chair Richard Clowder and said, do you want the bad news? The quiet period is over for the Federal Reserve, and he just laughed and couldn't stop laughing.
It was an uncontrolled laughter. It really raises this issue of the tension between the real leadership of the Federal Reserve and then all of the noise around the message.
Did you just call all those Fed speakers noise? I think you did.
No, but here's the issue. As a market participant, it is noise that you have to pay attention to, but when you get non-voting members that try to influence the conversation, that don't necessarily pay attention to the main conversation of the leadership, what does that do to credibility of the Fed? And it really raises some questions for longer term.
I totally agree. Joining us now here in New York, I'm pleased to say, Phil Camporelli, portfolio manager at JP Morgan Asset Management, staying awake all weekend waiting for Aaron Judge to do something he never did. Phil, we'll talk about that a little bit later. Let's start with this market. One good reason to be bullish right now, Phil. What is it?
Well, one good reason to be bullish is that we have rates that are getting to a point, John, where we think at a minimum should provide some ballast. And if we're really transitioning, John, from an environment where folks are really worried about inflation to a point where growth and earnings and margin compression start to take hold, the bond market should play a good role in a portfolio. But here's the real problem with risk assets, and this is why we're positioned so defensively. Policymakers wish they can use a scalpula. Instead, they're using a sledgehammer. And when you use a sledgehammer, you're going to break things. And I think that's what's happening right now in markets. And this is why we have in portfolios about an 8% underweight to stocks in a 60-40 type portfolio. And we have no real reason to adjust that at this point.
Mostly away from stocks. They are stochastic adjustments. It's pointy. You go down, something changes, you go back up. And to your point, Greg Valliere was scathing about the Fed middle of last week and reaffirms that this morning. He just says they flat out blew it a year ago and they're blowing it right now. How does your world change if Chairman Powell blinks? He goes to 75 to 50 or even more.
Yeah, so in a way they're getting there, Tom, because most of their tightening is already done. So I don't think they're going to blink anytime soon. There is no Fed put with an inflation rate with an 8 handle, but they are getting there. They have completely bought into the fact that they're going to move by another 125 this year, maybe another 50 next year. But Tom, at that point, they're at a point where they can pause and assess what they're doing. I think they're really afraid of going by 75 basis points. They don't know what the ramifications of that are, but they have no other choice.
Well, we're seeing the ramifications right now. Lisa, help me here. Do we get to a point on West Texas Intermediate where it gets so low that it's too low? I mean, it's $69 a barrel. What do we do?
Well, it'll be too low with respect to the message that it's sending about global growth. And Phil, this goes to the question of your 8% underweight of stocks in your portfolio. What are you holding? What are you buying?
Yeah.
When do you start to change?
Yeah, so here's one thing that caught our eye on Friday, Lisa. The American Association of Individual Investors, their bull-bear sentiment hasn't been this bearish since March of 2009. And we all remember what March 9th of 2009 was the bottom of the market, and it got very bearish. But again, we are not at the point where we're adjusting just yet. We are very, very interested, though, in the front end of the U.S. curve. So things like cash, which I used to call trash in the world of negative interest rates, zero interest rate policy, right? Those sort of things for us make some sense as we sit and wait. We also like investment grade corporate bonds. I think the positive real rate story that you were referring to a couple of minutes ago, that really hurt mega cap stock, that really hurt some of the portions of the market that did so well in the last cycle. Investment grade corporate bonds in the front end of the U.S. curve makes some sense for us. Now, this isn't the most glamorous trade ever. I wish I can come here and say we believe that you should be buying stocks here, but not just yet. So overweight the front end of the curve. Cash makes some sense in the portfolio as we sit and wait, but not yet on the stock market.
Phil, we've just left behind a market regime dominated by zero interest rates, negative rates in various central banks, including Europe, the ECB, the S&P, and elsewhere, and QE. We've blown that up in the last 12 months. Phil, any reason to believe we ever go back to it anytime soon?
You never assign a zero probability to any event. I was taught that a long time ago. Also, John, the Bloomberg Aggregate Index is having its worst year ever.
I'm just typing it up. It's just like we're channeling here, John. It's too much. Camporelli and I are channeling it. It's like this is a night for a judge if he's playing. John, the index that Phil's talking about, negative 18% from the top.
Carry on, Phil.
Yep. So I think at this point, it's hard to imagine going back anytime soon. However, as I mentioned a couple of minutes ago, they're almost at the end of their tightening cycle. What happens, John, when we do get to the point where inflation is not an 8 handle anymore, starts to move lower, and then you have an environment where growth is scarce again, which brings to the forefront all of those mega cap growth stocks. However, that's not right now. Right now is be defensive and look for the opportunity to add back to risk if and when the Fed pauses because of a deliberate and explicit move lower inflation. John, that's not any time over the next couple of months.
A final question, Phil. Does Judge get it done?
Of course he gets it done.
Does he?
He's Aaron Judge. Of course he gets it done.
TK's hoping he doesn't get it done.
My prediction is 64 home runs, John.
64. Okay.
But this is surveillance. The questions are tougher. What uniform is he wearing next year?
He's wearing pinstripes, and there's no doubt about that. But Tom, I've been wrong all year about rates and stocks, so don't ask me.
Steve Cohen noticed that. So like Steve Cohen's, come on. Yeah. Cohen, this is just screams Steve Cohen is going to pony up the big money.
No, Aaron Judge is the next Derek Jeter. He'll be the next captain of the Yankees.
How much have they got to pay to keep him in a Yankees uniform?
Inflation adjusted, a lot of money, John.
Like hundreds of millions, right?
Yeah, a little more than they offered him before the season started.
Unreal.
Brian Cashman may be a worse trader than anyone on Wall Street.
Baseball money, TK. Just unreal.
Yeah.
Unreal. Phil, good to catch up. Thank you, sir. Phil Camprelli of JP Morgan Asset Management there. Futures down, 9/10. Bit of bonds, bit of baseball. Just for you, Tom.
Yeah, I love it.
Okay.
We didn't mention the Red Sox. Lucky me.
We're going to skip that.
Yeah.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Conservative lawmakers say the Bank of England may need to step in to halt the panic over the plunging pound. Sterling fell to an all-time low against the dollar today over concerns about the new government's tax cuts. Some conservatives believe an emergency interest rate hike looks increasingly likely. The OECD has slashed its global forecast for next year, saying the world has been jolted by the war in Ukraine. The Paris-based organization says the global economy will expand just 2.2% in 2023, and that's down from its previous forecast of 2.8%. The OECD also expects further interest rate hikes. Italy is on track to have its first female prime minister. Giorgia Meloni won a clear majority in Sunday's election, and that sets her up to head the most right-wing government since World War II. Meloni emerged from the political fringes after leading the opposition to Mario Draghi's technocratic administration. And Ukraine's President Volodymyr Zelensky is calling on Russians to avoid the Kremlin's mobilization effort by fleeing or surrendering. Zelensky says that would help bring a quicker end to what he called the criminal war. Russian men fled to the borders over the weekend after Vladimir Putin's order to call up another 300,000 troops. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When the Fed makes its call,
a unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
We're taking it seriously. It's not the first time President Putin has made a nuclear threat in this conflict, and we have communicated directly, privately, to the Russians at very high levels that there will be catastrophic consequences for Russia if they use nuclear weapons in Ukraine. We are planning for every contingency, and we will do what is necessary to deter Russia from taking this step, and if they do, we will respond decisively.
It's not private anymore. That was Jake Sullivan, the U.S. National Security Advisor on ABC over the weekend. Live from New York City, this is Bloomberg. And equity futures are down 0.75% on the S&P. On the NASDAQ, we're down about 6 or 0.7%. Yields are higher by 10 basis points now on a 10-year, 378.48. Hard to keep up, Tom. Keep saying that. But euro dollar, hard to get comfortable. Just used to. 96.31 on euro dollar, 107 on sterling. It was 103 earlier this morning.
John, I've been doing this for a few years, and I look at the screen, and every time it's a shock. Right now, it's
relentless.
Euro breaking down.
It's relentless.
Euro is almost through the 0.9626 level to new weakness. On today, we're not even watching that. We're watching sterling and the rest. Futures negative 26, Dow futures negative.
Thanks for that, Tom. Lisa writes in from 6 feet away. The Mets are doing just fine without Aaron Judge. Just wanted everyone to know.
I didn't want to, break into the heated conversation, but just
as
let's
a
make
Mets
that
fan,
clear.
you're entitled to jump in and just say what you think.
Let's be honest, they're doing really well.
Doing very well.
Carry on.
Sure, thank you.
Fine. I predict that Mr. Cohen will give Aaron Judge equity in the franchise.
Is that what you think, Tom?
I think he will give him equity in.
Is that just to boost his price, TK, and to make it more difficult for the Yankees to hold on?
I think there's part of that. I'll leave that up to Mr. Cohen to comment. Steve, if you're watching this morning, we'd love to have
Phone
you on
in.
our
We'd love that.
baseball segment. We don't have to talk, hedgy stuff. Right now, we're going to talk politics. Edward Mills with us. Ed Mills, Washington policy analyst at Raymond James. And what we've got here, folks, is decades of good experience. Jake Sullivan was warbling gaily about 1600 Pennsylvania Avenue's response. I don't care. I want to know what the Pentagon thinks about the Eastern Front of Ukraine and Russia. What is the Pentagon doing given a new Putin and a new nuclear analysis?
Well, Tom, I think the White House would say President Biden is the commander of the Pentagon as well. And I think that the thought here is the message has been clearly sent to Putin. It has been sent to his generals. What I think Putin would have to be very concerned about is how well we were kind of anticipating the Ukraine invasion, how good our intelligence is. And I think that the subtle or not so subtle message that Jake Sullivan was sending is regime change would be at the top of the list if Putin were trying to use any sort of nuclear weapon to respond in Ukraine. And so that he has to be fearful personally if he were to do something to escalate this war.
In my youth, the great summary, and this is with Gorbachev dying recently, we really didn't have good intelligence on the Soviet Union at the time. As a Washington watcher, do you suggest our intelligence is better than good here and better than it was back then?
I think in the lead up to the Ukraine invasion, it was freaky good. And I think it was so good that our allies did not believe us. And that was probably one of our biggest challenges. Zelensky did not believe us because we've had some pretty big intelligence failures. Look at Afghanistan, look at Iraq. But we knew exactly what Putin was going to do before he did it. Unfortunately, it did not stop the invasion, but it certainly sent a message to the Kremlin is we're watching you and we know exactly what you are doing here.
There's also a sense of desperation that's coming from the Kremlin, especially as you see potential conscripts flee the nation at a rapid pace from Russia, trying to get out before they're being sent to the front lines. You're also seeing Russia trying to make Ukrainians into soldiers for them after grabbing their territory. What's the end game here? How concerning is it?
Lisa, you're right. And I think that what we're seeing here is, some acts of desperation coming out of the Kremlin, coming from Putin. The concern is that they do have much more that they can escalate. We've described this as a attempt to escalate to maybe go into stalemate, trying to kind of just re-center what is happening in terms of the Ukrainian pushback. What we're watching at Raymond James is one of the ways in which Putin could kind of escalate is through his kind of militarization of energy. There is an energy embargo on Russian oil going into Europe coming in place on December 5th. The United States is trying to do a first time ever kind of price cap to allow that oil to flow still into Europe. But if Putin further weaponizes energy, which we've seen with the Nord Stream pipeline, how much does that add to the economic concerns that we're seeing in Europe? How much does that add to inflation? How much does that add to kind of the kind of fragility potentially of the U.S. NATO alliance?
Ed Mills of Raymond James, we've still got to get through winter in Europe. It could be a tough one. It's going to catch up, sir. Thank you very much. Lisa, we've still got a quarter left and some of the year for financial markets, and it's felt like a long one already. There's still 3 months plus to go.
The consensus right now for most fund managers that we speak to seems to be buy short-dated U.S. bonds and go to cash. This is not exactly a ringing endorsement of risk. And what we're hearing is they're waiting. There's no reason for them to go into risk because they're actually earning something to stay where they are, and the uncertainties are just growing, especially with this backdrop of the political uncertainty and a war and a dictator who is completely unpredictable and backed into a corner.
That's only one part of the story. Then elsewhere, you've got global bond yields surging, the dollar that's absolutely dominant. Sterling earlier 103.50 on cable, right now 107. Guy Labat of Jenny Montgomery Scott on Twitter. The Prime Minister's spokesperson in the UK said, we won't comment on daily market moves. And Guy said this, Tom, this isn't a daily market move. It's a yearly one that happened in 3 business days. That's how big the move has been. It's been a yearly one in 3 business days.
And that goes to what the pros worry about, including the managing director of the IMF, Dr. Georgieva, the rate of change and the rate of change of the rate of change. We're at second derivative moments here, John. I looked at Canadian dollar. It's log convex. There's an acceleration here, obviously off of oil and other issues as well. How do you do a 14% depreciation of the loonie if you're, crossing the Niagara Falls into Buffalo? You're getting killed.
Jordan Rochester's going to weigh in on this, Tom. Looking forward to catching up with him, the G10 FX strategist over at Nomura, joining us very, very shortly with a dollar stronger against the pound and pretty much everything else. Euro dollar, sub-parity. We're now talking about 96, 95, maybe even 90. Right now, 96.20 on euro dollar. Futures down, as I say, by about 0.75%. Yield still climbing on a 10-year. 378.28, up 10 basis points on the day. Unreal. Lisa Bramington, Tom Keane, I'm Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Live from New York this morning. Good morning. Here is your Monday morning price action. We're down on the S&P by 0.7%. A 4-day losing streak into Monday. It looks like it could become 5 at the opening bell. On the Nasdaq, we're down about 0.5%. On the S&P, June 16th low, 3666. We're sitting right on top of it going into the opening bell. We'll see if we break below it around the cash open. Looking at the bond market, 2s, 10s, and 30s as you were. Yields up. 12 consecutive sessions becomes 13 consecutive sessions of yields higher at the front end by 10 basis points on a 2-year now. 430 on a 10-year, 378. You can do the maths, Tom. 2s, 10s. What are we now? Negative 50-something? Negative 50-something.
Big moves in the real yield. My eyes are failing. I mean, 9 basis points now, John. That's a wow statistic. That's a big Monday morning move on the inflation adjusted.
Do you want the year-to-date carnage, Tom? The year-to-date carnage.
The carnage?
The year-to-date carnage looks a little something like this. We are higher on a UK 2-year, year-to-date, by almost 400 basis points. 388, call it 389 higher. On a German 2-year, we are higher by 262 basis points. On a US 2-year, Tom, just a mere 357.
Yeah, I'll editorialize, John, and say this is moving very quickly, and it always redounds back to Washington and the New York Fed. That's what I would watch.
That's the pain, Bramo. That's the epicenter of it.
Where's the Japanese 2-year yield on this?
I think you can guess. You can guess what that's done year to date, which is not a lot.
Absolutely nothing. I wanted to take a look at some specific movers and specific names and what's happening underneath the surface. John, you were asking before, when do we see the downward revisions, not only in the global economic outlook, but also in earnings? And what I'm looking at right now is the transportation stocks, because they are often a bellwether of what's to come. We've heard from FedEx. They've downgraded their expectations for earnings because less stuff is moving around. People are getting less optimistic and buying fewer items. You could argue this is just a rebound to normalization from the pandemic. Whatever you want to make it the argument, there is a direct correlation with these stocks going down and economic prospects deteriorating pretty rapidly. FedEx shares over the past month down 32%, but also UPS in sympathy, down more than 17%. Just to put into perspective, the S&P over this period is only down 10%. Norfolk Southern, the railroad shipping company, down almost 14%. And XPO Logistics, this is what I find actually most interesting, Tom. This is the one providing services, logistics services, to a lot of transportation names, down nearly 20%. How much does portend a lack of economic momentum heading into the end of this year?
This is really good, Lisa. You got to do more of this. I mean, this is hugely valuable, getting us away from on what? The same 12 stocks we follow, every day, whatever it is. Lisa, thanks so much for that. Just brilliant, truly brilliant here. Futures negative 25. The VIX out a solid 2 big figures. That gets the equity market going. On foreign exchange now, Jordan Rochester, I'm going to get one question in here on the globe. John, I know, wants to focus on sterling. He is with Nomura. Jordan, I'm looking at the intervention experiment of the Japanese. They've made back on a Fibonacci retracement about 70% of the intervention value. What happens to yen? What happens to those institutions when the yen weakens back to where it was before they intervened?
It puts the pressure on the politicians, Tom, to do something about rates rather than focusing on the FX intervention. The main problem is for Japan, they are one of the few central banks to still have low interest rates and to be conducting quantitative easing purchases. Until they stop those quantitative purchases, this yen intervention is unlikely to have a material impact on moving the yen to a stronger place. What it has done is taken the steam out of the long dollar yen trade. It does make us question, what's the upside in being long dollar yen when you're fighting a central bank with one of the largest FX reserves in the world. But at the moment, the first order was the Japanese most likely use their cash balances. So it had very little impact on the US rates market. But if it carries on, it will probably lead to higher US yields, which will make this FX intervention even more difficult to lead to a stronger yen.
And John, that's how everyone's different, as you mentioned earlier, where Japan has ample cash, maybe the United Kingdom does not.
Well, the other issue as well, Tom, with Japan, it's a very domestic bond market, and Jordan can speak to this much better than I can. So a lot of that is priced in yen, the debt, Tom. A lot of it is held at home. The thing I'd say about the UK, and this is an important difference too, is that yes, a lot of them might be held abroad, 30% of the gilt market held abroad, but Jordan, a lot of it is sterling denominated anyway, so they don't have that foreign currency problem. So Jordan, I think the issue we're all trying to grapple with in the UK right now, is this just a normal required adjustment needed to attract capital to finance a big fiscal package through a weaker currency and high yields? Or is it something bigger than that, something worse? Do we have the ingredients required to have that self-fulfilling downward spiral?
I think it's something worse, unfortunately. I don't want it to be worse. This is the country I earn my money in. I'm long sterling, naturally, from my salary. But we've just put out a piece just before this, I came on live on air. We've now revised lower our sterling view. We were looking for 106 by year end. As you know, we've gone through that rapidly quicker than I expected as well. So now we've adjusted our view. It seems like the market is focusing more on the terms of trade deficit that the UK has when it comes to the current account, but there's a terms of trade story with high energy prices and UK imports skyrocketing. So now we're looking for 97.50 in cable by year end. So that is unfortunately below parity. And I've been kind of toying whether to make that call sooner. And the reason I didn't was I thought markets would be concerned about the Bank of England raising rates, and that would support the sterling. But now we've switched to an emerging market style crisis where it's become very clear that even with rising interest rates in the UK, it's becoming less attractive to investors as this crisis goes on. And therefore, I think we break through parity in cable before Christmas, probably by the end of November, and we get down to 95. So the end of March next year. That's if nothing is done about this supply side crisis in Europe and if we have high energy prices continue. I could be wrong though.
Yeah.
I could be wrong if three things happen. The first one is if we have the Bank of England raise rates. Now we're expecting them to step in with some sort of warning in the market. Ed Conway from Sky was suggesting that might happen today. If they don't raise rates, there's about 80 basis points priced this week. So if they don't raise rates this week, sterling will probably take another hit. But the main thing is on the government side, it's not really the Bank of England that's being challenged here. It's because we're not having a fiscal policy with fiscal rules tethering market expectations to a sort of sustainable fiscal spend. And because of the government doubling down over the weekend saying there's more tax cuts to come, it's why we expect more of these sort of moves to come too.
Well, so Jordan, let's pick up on some of those points. Traders now pricing in up to 200 basis points of rate hikes by the Bank of England by November. There is a question, what do yields have to do to get to that 97.50 level without complete capital flight by foreign investors, which is the fear that a lot of people have. We're looking right now at five-year yields on gilts going vertical, basically at 4.6% right now, up half a percentage point every day, it seems like. Where do we stop here, given your outlook?
Well, we're looking for a terminal rate in the UK around 4.5%. The market's doing pretty well, getting close to pricing that. That's below by about 100 basis points where we think the Federal Reserve will get to, so 5.5 for their terminal rate in this cycle. We've just literally revised up that Bank of England call. We were looking for 50 basis points at the next two meetings. We're now looking for that to be in clips of 75. So it's quite clear the Bank of England do need to step up. Now, what will stop the problem is not the Bank of England. So the reason I mention this is because with an emerging market, there are two ways to stop a currency crisis from getting bad to worse. The first one is aggressive rate hikes to kind of stamp out speculative trading and also to make the risk return on assets more attractive for foreign investors. But the main thing boils down to where the problem is in the first place, the fiscal side. So usually in the EM space, you'd say, let's have some fiscal austerity, please, guys, reverse those tax cuts, and that will shore up the confidence of investors. We're not getting that in the UK right now.
Jordan, as you said, there is some talk about the potential for a Bank of England news conference in the near future. What can they say? What would they potentially do in such a statement?
Well, they need to talk about financial stability, price stability, foreign exchange stability. If the market gets into a framework where the Bank of England is reacting to FX moves, any move we have then met with a rate hike, then perhaps it stems the fall in the currency, the pace of the fall. But the main point from me is that the pace will probably slow down. We're quite used to having flash crashes in sterling, unfortunately, since Brexit. So it's not the first time I've woken up seeing on my phone the pound's tumbled 4 to 5%. Usually this leads to a sort of mean reversion, the pound recovers. But as I said, this time round is a fundamental regime change that's taken place in the UK. In 2016 to 2019, the market was trying to price in what Brexit could look like. Now we know what it looks like, and we've got this energy crisis pushing the trade deficit and the current account deficit to historical wides, 8% current account deficit of GDP. This is the definition of a country that should be experiencing these moves in the FX market. So until that changes, until energy markets, if we see prices collapse even further, then maybe I can change my tune. But on the Bank of England's side, if they do 100 basis points, let's say this week, and if they signal that they're ready to do more, so give the idea of another intermeeting rate hike, that could help slow the pace of the move. But the point for me is it won't stop it.
Well, Jordan, if they did that, they're responding to the move in the market or they're responding to fiscal policy. And what on earth does that look like going into the weekend in a Conservative Party conference?
Indeed. The idea of the statement from the Chancellor was that he has been speaking to the Bank of England, I think, twice a week was what he said. So it would be quite embarrassing for the Bank of England because we assumed that they have been given a heads up as to what was in the fiscal package, but when they made their decision last week. And like I said, this is a market reaction function to the fiscal side. If we look at last week, we had the Bank of England we had a hawkish 50 basis points. We had some members voting for 75, and the market took it pretty well in terms of FX at least. I know gilt's moved quite a bit, but in the FX space, the pound held its ground, waiting for that budget. But it kind of boils down to a point that my colleague Andy Chater is making. What we learned from the budget last week is fiscal rules are out the window until December, when we get an idea of what they will be in December. And that uncertainty has made the fiscal side more untethered. And that's what markets hate the most. It's that uncertainty as to what the UK will look like in a few months' time.
Jordan, good to hear from you. Jordan Rochester there of Nomura. The range on sterling today, I'll offer it to you. The low, 103.50. The high, 108.46. And right now, just short of 108. That is a monster range in pound sterling against the US dollar. Futures lower 0.6% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The sell-off in UK assets has gone into overdrive. The pound plunged to an all-time low before rebounding and government bonds were slammed. Now there are calls for aggressive rate hikes by the Bank of England. The latest tumble was fueled by Chancellor Kwasi Kwarteng's comment on Sunday that there's more to come on tax cuts. In China, the Communist Party has reaffirmed President Xi Jinping as its core. The party published its list of almost 2,300 delegates to attend next month's leadership summit. The announcement brings Xi a step closer to clinching an unprecedented third term in power at the event. The price of oil is sinking again thanks to the strength of the dollar and fears that a recession will hammer demand. Brent collapsed below $85 a barrel at one point for the first time since January. The benchmark fell almost 6% last week. Perella Weinberg Partners is naming longtime investment banker Andrew Bednar its next executive officer. Now, Bednar is taking over from co-founder Peter Weinberg in January. He has been co-president of the firm for more than 2 years and has worked on some of the firm's largest transactions. Credit Suisse says it's working on possible asset and business sales. The Swiss bank is looking for ways to cut costs and restore profits under a strategic plan to be announced next month. No details yet, but Bloomberg has reported that Credit Suisse is considering the sale of its Latin American wealth management operations, excluding Brazil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
we're going to do all that we can at the Federal Reserve to avoid deep, deep pain. And I think there are some scenarios where that's likely to happen. There will likely be some job losses. But I think if you look over the historical history here and our economic experiences, there's a really good chance that if we have job losses, it's going to be smaller than what we've seen in other situations.
That was Raphael Bostic, the Atlanta Fed Bank president, on CBS over the weekend. From New York, a whole lot more Fed speak still to come. Lisa can hardly wait. Futures down 6 or 7 tenths of 1% on the S&P. It's not just you, it's me too. And Tom, and pretty much everyone watching and listening. Futures on the Nasdaq down about 0.5%. Yield high by 8 or 9 basis points, 377 on a 10-year. What a turnaround it's been. The dollar dominant, as it often has been this year. Euro dollar 96.46 with negative 0.4 of 1%. Senator Warren with things to say on the Federal Reserve again just yesterday evening. Fed Chair Powell seems determined to push the economy over a cliff, even after he admitted rate hikes won't lower key prices. Destroying jobs and crushing wages of millions of workers is reckless and dangerous. Recession is not the solution to inflation. Tom, Senator Warren over the weekend.
Well, she's going to have a lot to talk about here, and what she's talking about is instability. Politicians always hate instability, but John, I would really focus on imagining where we were on the lawn at Jackson Hole with our good interviews and with the events of the last 4, 5, 6 days, led by the United Kingdom, but not just the United Kingdom. The script has changed for all these Fed speakers today.
That was 100 basis points ago.
Yeah.
For anyone that's,
well said.
that's following.
Yeah.
We were at 339.66 at a close on August 26th, and Lisa, right now on a 2-year, we're at 429.
So when do we feel this in the forward growth expectations, particularly in profits? Why are we not seeing a big ramification on stocks? And you've mentioned this before. We've been talking about this. And on a day when the dollar is preeminent, when it's roiling everything else, you see bond yields surging. Stocks aren't necessarily tanking. It seems rather orderly. And this, to me, is one of the biggest questions that we've seen over the past few months.
What do we go back to? I think is the one I'm spending a little bit more time thinking about. If we've just blown up a decade of zero interest rates and what many people at the time, including yourself, Lisa, referred to as a bond bubble, well, that bubble's just burst. What replaces it? What are we going back to? Are we going back to the previous decade anytime soon, or are we transitioning to something very, very different?
And what happens if big tech doesn't return to a leadership position in equity indexes? Who then takes the mantle? Is it healthcare stocks? Really? Can healthcare and hospitals really take the lead? But that's where people are hiding out. Can it really be some of the industrial names that are flat on their backs because there's less transportation right now in the face of some sort of economic downturn? You know, there is an entry point. And you can feel this in every institutional investor who comes on, getting cash, looking for flexibility. But where is it going to be? And what's going to be the goal over the next decade?
Just to pick up on something you said, how compromised will the index be now, given the weightings of some of those big names that have been fueled in some places by what's happened in the bond market? And if they are compromised, have we also just blown up the passive strategy that's done so well over the last 10 years, Lisa, off the back of some of this?
This is what a lot of fund managers are saying. This time is different. Single names will actually be the way to outperform, and you actually could get hammered if you stay in some of these index strategies. We'll see. I mean, it depends on whether we get the cathartic puke that we were talking about earlier, because if you get that kind of selling, then all of a sudden you get a buying opportunity. But it just hasn't gotten to be that sort of catharsis yet, as evidenced, Tom, by your VIX.
Chris Harvey hasn't said it yet. I tell you what, I'd love to catch up with Chris.
Yes,
I've got so much time for someone that's just willing to come out and say, got it wrong. Because forecasting is tremendously difficult, and often you get it wrong. And this is what he said this morning, Tom. Our belief that we would not retest the 22 low until the first half of 23 was wrong. Despite retesting the lows, we feel the market bottom has not been established and stocks will make lower lows in 23, and EPS estimates come down, and the Fed tightens into recession. It's that last piece of it, Tom. It's that last piece of it that people have been waiting. I say people, the likes of Mike Wilson and Morgan Stanley, waiting for that shoe to drop.
And it's the unexpected, in this case, Trussonomics and the global ramifications of that as well. I thought Lisa's board on the railroads there earlier was really important. John Ben Emmons also, with incredibly thoughtful notes, puts out the path here about we go risk on, things started being unstable, and it lifts all boats into the IMF meeting in October towards some levels of illiquidity. And I mean, that's the reality, that's the worry that's out there right now towards that key IMF
Lisa
meeting.
used an important word though, Tom, orderly. Lisa, anything about this from your perspective, is anything about it disorderly?
Yeah, the United Kingdom market right now. period, full stop, which is the reason why we're focusing on it as much as we are. It feels unmoored when you see a 50 basis point move in the 5-year gilt yield every single day in consecutive days. When you start to see the pound fall out of bed and people basically saying parity is around the corner with the dollar, we have never seen this before, right? So those are disorderly and might be spurring some sort of response, perhaps from some policymakers. We don't know. We're hearing rumors. Not in the rest of the world, though. You know, at what point do we get a trigger from Japan? At what point do we get a trigger from China, where you see the yuan actually weakening to levels that we have not seen for more than a decade? All of these questions, at what point do they come together to create a tension that just has to be addressed?
The tension at the moment, I think, is rate hike pricing over at the BOE. Yeah. We're talking about an extra 200 basis points now, not over the next year, by November. Tom, by November, can the BOE actually step up and validate the kind of pricing we're seeing baked in by markets, or 200 basis points of it by November? Tom, that sounds like crazy talk.
It sounds like crazy talk, and when you look at the Bloomberg screen and you look at the standard deviation moves, these are crazy talk moves. So you don't say no, but I would think of the second and third order ramifications of that rate increase that you're talking about.
Ahead of a Conservative Party conference later this weekend, Lisa, the political aspect of this, not lost on anybody.
Okay, so let's say the Bank of England comes out and hikes rates by 200 basis points by November, basically saying, you want to do this, we're going to basically guarantee that we're going to slow the economy or torpedo it even in order to get some kind of rationale back into the market. Well, then what is the political response? And John, you've been asking about this. How do they strip them from some of their power then? Or do they
consider that? And that was a consideration through the summer that they, I think, tried to address when they first took over. It was something that the Chancellor basically addressed, that the Bank of England independence was somehow secure. The rate pricing issue and how the government would respond to a Bank of England if they did step in is part of that spiral that is so unnerving for everyone. At the moment, a bigger fiscal package is boosting this idea that monetary policy steps in. And to Lisa's point, Tom, if monetary policy steps in, does it then mean that the government comes back and says, hey, there's more to come? That's the kind of self-fulfilling spiral where things can get even messier. And we're wondering where the circuit breaker comes from right now.
Well, the circuit breakers can be there in obvious things like the political battle of Great Britain, but I'd go back over to the Pacific Rim, John, and look at some of those measurements, the JP Morgan EM index and the ADXY, which is the JP Morgan series away from yen. And what it shows me when you look at it log is instability there as well. This is not just about the soap opera known as the United Kingdom.
No, it's not. It's about the dollar, it's about global bond markets, it's about everything else. And Tom, you've got to spare a thought for a bond market that 12 months ago had a 2-year at about 20 basis points in America, and now it's 428.
Are we going to get a 77 on West Texas Intermediate?
Who knows? I mean, not far away.
We're not there. We're there.
Futures down to 0.6 on the S&P. On the Nasdaq, we're down 0.5%. Live from New York, heard on radio, seen on TV. This is Bloomberg Surveillance.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
It's about global growth, it's about Fed hawkishness, and it's about risk appetite.
This was all because of the way market interpreted Fed's rhetoric.
Clearly, the Fed has been guiding the markets.
Monetary policy is really powerful, but it's not a Swiss Army knife. You know, it's not a multi-purpose tool.
I think a soft landing is something that you want. It's not something that you would ever count on.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. An historic Monday occurring. And John Farrow, I just saw it in a note from Nomura and Jordan Rochester, the unimaginable, the prediction of sterling below parity. Jordan Rochester says hope is not a strategy for your United Kingdom.
And here are the numbers, Tom. 97 by year end, 95 by Q1 next year. Dollar dominance continues, and sterling at the moment, Tom, a real victim of that.
For those that don't keep score of this, these are unique times, and they are globally unique times. We're thrilled to bring you later on. Brad DeLong will join us with a new book from Berkeley. Skit Jukes will be with us here in a bit, and Gene Tenuzzo to talk to us about the damage in fixed income. John, the damage is pretty much everywhere, although equities are sort of doing okay.
Just about hanging in there. We're down 0.6% on the S&P, but Tom, still today repricing the terminal rate at many of these central banks. We're looking at an extra 200 basis points from the Bank of England being priced in this market, not by the end of next year, but by November. By the November meeting, an extra 200 basis points, which is just phenomenal stuff. The 2-year in America, and we talked about this a lot, 12 months ago was something like 20 basis points. Right now it's close to 430. Tom, it's a massive, massive change that this whole market has to price off and readjust to.
A headline from Bloomberg, and when they're important, we do what's called a red stickies. Some of you will see that on television and not on radio. Red stickies on radio look good too, John. Bank of England still to decide if it will comment
on sterling and the move we've seen. It's a tricky spot for the Bank of England, Tom. They only met just last week. A day later, we had this fiscal event. Got a series of Conservative Party, Labour Party conferences this week. So politically, it's pretty tense as well. Does the Bank of England need to respond to something if they believe this is disorderly? Do you believe this is disorderly or just an orderly adjustment to attract capital back into the UK to finance a monster deficit, Tom?
Well, we'll see. It's original economics. Certainly that was the reading over the weekend. Lisa Bramowitz is looking at yield up and price down. And I'm, as we mentioned with Phil Campariel of JP Morgan, Lisa, I'm sorry, price down is negative 18% from the joy of months ago.
It's been dramatic. And on the flip side of that, let's talk about how much yields have risen. We've been talking about the 2-year, the 5-year, the 10-year in the United States, how high real yields are going. In the credit sphere is possibly one of the most interesting stories that I have seen in the past decade, where you're suddenly getting yield, real yield, absolute yield, nominal yield, yield, 9.25% yield on high yield bonds right now. It's nearly distressed, and yet still not enough to lure people in. What is the entry point enough to lure in capital around the world in specific areas and for corporations?
I'm going to begin the data check, John, with a pro tip. And this is you look at $2 indices to see the EM effect. And this morning, EM is crushed. DXY is up 0.5%. And the Bloomberg Dollar Index is up 0.7%. That's a quick way to see that EM is just crushed on strong dollar.
I'll whip through things quickly and start with the equity market. We're down 0.7 on the S&P. Yields are higher. Again, it fuels another leg up in the US dollar. Dollar stronger. Also worth going over the year-to-date numbers. And we did that earlier on, but if you missed it, the numbers are staggering. 20% move on sterling, weaker. 20% move on the yen, weaker. On the Swedish currency, 20% weaker. Norwegian currency, 17%. The Kiwi in New Zealand, 17%, 16%, 15% in Denmark. The euro, 15%, 10% the Aussie. The Swissy, 7%. The Canadian dollar, 7% weaker. Tom, 7% is a big, big number typically. That's real weakness. That's the relative outperformance this year in G10. These numbers, Tom, they're really, really quite large, and it's off the back of just repricing this Fed a whole lot more than we did at the start of the year.
Please stay with us through the day as we look at Fed speaker comments as well. And of course, institutionally, all of these people, I would say, John, staggering to IMF in October. I mean, sort of, that's the next benchmark here where everybody gets together to say, what now?
I need to get to the end of the week first, Tom, before I think about October. Then we've got a whole quarter until year end.
Let's try to get to the end of the hour. We do this with Gene Tenuso, head of global fixed income at Columbia Threadneedle. Gene, how has your world changed since Friday?
Well, Tom, the world has been changing all year. It's been a pretty volatile time for the bond market, as you know, but I think, what the Bank of England and the fiscal policy making, I should say, in the UK brings to the bear here is that it's not just domestic forces that are driving yields in the U.S. It's been a painful time in the bond market, but there are forces happening in other developed markets that are, basically unconventional policy driving yields to new highs.
I look at the price decline, and that's usually what I focus on, but let me be more optimistic today that in investment grade paper, I can finally get a legit yield. If I can get 5% on corporate stuff, how much of this do I want to do? How much do I want to load the boat moving from 2% yield out to an attractive 5%?
Lisa just said it, Tom, yield, yield, yield. And I think this is the year that fixed income got its last name back, right? Now, if we look at investment grade assets, these are, bonds from companies with significant cash flow that can weather economic and inflation volatility. We're now at a level where not only is that overall yield higher on a real basis, on a nominal basis, but also relative to other risk assets like equities, we see that dividend yields are almost 4% higher. Corporate bond yields are almost 4% higher than dividend yields. So the value proposition is very attractive. We've been moving that way in portfolios, and we think that it might be a little bit early in high yield given the potential for more economic weakness, but investment grade we think is very attractive here.
When do you start moving into high yield at a time when people do not expect there to be the same kind of default cycle this time around?
We just haven't seen that capitulation yet, Lisa. I do think that there are reasons why a default cycle, even if we go into recession, will be more muted. because we have just recently had several default cycles within the last 7 years. We've had, a handful of them that have washed out energy companies, that have washed out other weaker balance sheets during the pandemic. So we tend to think if you get to that, 700 or 800 basis point range, lower than the 1,000 basis point spread that typically characterizes a recession for high yield bonds, we think high yield would be attractive at those levels.
Gene, something we've reflected on this program through this morning and over much of the last few months is the fact that we've just blown up a decade of stimulus, QE, zero rates, sometimes negative interest rates. We've blown it all up in the last couple of months. Gene, do you think there's anything about that era that sticks? Is there anything we return to?
I absolutely do, John. I think all of the toolkit that we've put into place from the financial crisis through the pandemic are tools that will remain in the toolkit. I think what we've realized here is that central banks can move to tighten very quickly, but we have to remind ourselves the Fed really only started tightening 6 months ago, and that was even very gradual at the start. So we haven't seen really the economic impact of most of the tightening yet. And I think that's what we're going to see in the fourth quarter is real evidence that these measures that have tightened monetary policy and moved the Fed funds rate to restrictive territory are having a real economic impact and will start to give Powell that compelling evidence of inflation easing that he is so desperately looking for.
And Gene, this is where, stock traders always come on and give us their opinion about rates, and then rates traders basically say you're not going to feel the effects until the fourth quarter, which just sort of breathes downward revisions to earnings. But I'm not going to go there with you and force you to put your equity trading hat on. I'm just wondering, though, if we have a sense of when the bulk of the rate hikes that have been baked into market expectations will really hit. You said we'll start seeing it more in force in fourth quarter. How long is the lag time?
We think it's 6 to 12 months, and we started this rate hiking cycle 6 months ago. So, we're really at that point now where I think, if we think about making investment decisions, not over a 6-day or 6-week period, but over a 12-month period, which is what we try to do, at a minimum for our clients, we think you will have ample evidence that inflation is easing. And if we look at a 4 3/4 Fed funds rate from a terminal rate perspective that's already priced in next spring, we think that is probably too high, or there's a good chance that that's too high, and the Fed underdelivers on that. So the symmetry in the bond market is very, very different than it was a year ago. And I'd rather look at those forward-looking indicators than something like the dot plot from the Fed, which is useful but mostly backward-looking.
Hey, Gene, thank you. Gene Tenusa there of Columbia Threadneedle. I think that final point is a really, really good one, Lisa. It reminds me of something Ed Bradford said out on Twitter just last week, and we commented on it on this program. There's a difference between the Fed actually achieving what they've signaled and what they're signaling. It doesn't mean they're necessarily going to deliver it. This is what they want to signal right now. And to Gene's point, perhaps they fall short.
Which is the argument of bulls. This is sort of the mind-twisting aspect,
Sure.
that the Fed's not going to be able to go through with it. So they're going to try to play mind games with the market so that they can get the market to where they want it to be to affect the change that they want, so they could actually take the foot off the gas next year. And it's just hard to really understand whether the market's going to cooperate and what's going to happen.
It's tremendously difficult, because if everyone starts to believe what Gene just said, financial conditions ease again and the Fed has to keep them tighter.
Exactly.
And maybe they even signal a higher terminal rate further down the road.
Someone's screaming at the TV right now.
I'm sure they are. But until we find a circuit breaker for that,
it's true.
Then this carries on.
And that's where we see right now that people are starting to buy the message from the Fed. And it's not just the Fed, John. I mean, right? We've seen this from central banks around the world.
ECB included.
How do you bring those confluence of central bank decisions together? Never been done before.
They're all talking tough, Tom. They continue to talk tough.
Yeah, we're going to see what happens with the Bank of England today, I guess. That's the zeitgeist right now. Tape deteriorates. Here, John, what I would note in the last 10 minutes, we've seen West Texas Intermediate deteriorate. It's down 37% from mid-June. Nat gas in the United States down 34% just over the last month or so.
These are the kind of moves that Gene's talking about,
These are
Tom.
big, these are tangible moves nobody's talking about.
Kit Hughes of SocGen has been talking about it. He's going to join us shortly on this FX market. What a crazy couple of days. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Conservative lawmakers say the Bank of England may need to step in to halt the panic over the plunging pound. Sterling fell to an all-time low against the dollar today over concerns about the new government's tax cuts. Some conservatives believe that an emergency interest rate hike looks increasingly likely. The Bank of England has yet to decide whether it will comment on the pound. The OECD has slashed its global growth forecast for next year, saying the world has been jolted by the war in Ukraine. The Paris-based organization says the global economy will expand just 2.2% in 2023, and that's down from its previous forecast of 2.8%. The OECD also expects further interest rate hikes. Italy is on track to have its first female prime minister. Giorgia Meloni won a clear majority in Sunday's election, and that sets her up to head the most right-wing government since World War II. Meloni emerged from the political fringes after leading the opposition to Mario Draghi's technocratic administration. Perella Weinberg Partners is naming longtime investment banker Andrew Bednar its next chief executive officer. And Bednar is taking over from co-founder Peter Weinberg in January. He has been co-president of the firm for more than 2 years and has worked on some of the firm's largest transactions. More than half of U.S. shoppers are willing to pay more for healthy food, even as inflation cuts into their budgets. A survey from Deloitte finds that consumers see a connection between well-being and food choices. In order to save money, they're switching from brands to private labels and reducing online shopping to avoid fees. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. The Fed makes its call.
A unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
Quasi-quanting at the weekend fueled this sell-off of the pound by doubling down on his package on Friday and suggesting that there is more to come. That's not what financial markets want to hear. They want to hear that the Chancellor has got a serious plan for getting a grip of the public finances. We didn't hear that on Friday. We didn't hear it over the weekend. And now we have that reaction in global financial markets.
It's all upside down in the UK right now. That's Rachel Reeves, the UK Shadow Chancellor. The Labour Party talking about balancing the books, which is typically what the Conservative Party's doing, Tom, about the Labour Party, if you're up to speed. There we go.
John, that was brilliant. Can I ask a dumb question?
Nothing's dumb right now, Tom.
Do the people of the Conservative Party support Trussonomics?
That is one of the questions of the moment, Tom. Do they support it, given how the market action has built up over the last week? And will we get any kind of pushback going into the Conservative Party conference later on this week? I think that's an important question, Tom.
I'm almost afraid to look away from the Bloomberg terminal. There's so much movement. Futures at negative 31, VIX out 2.45 points. It's a challenging morning, which is always a good excuse to speak to Kit Chooks. He's chief FX strategist at Societe Generale. Can you commit a trade on sterling here, Kit? Can you advise SocGen clients of a tradable effort in pound sterling?
Look, I don't think in near term that you can sell it now on a Monday afternoon after such a big washout, but you've got to understand that if you buy it, you have to have deep enough pockets to be able to cope with the volatility. We have extraordinary levels of volatility, both implied in terms of what the market trades and in terms of what's coming. I do think we're not a million miles from the bottom, but we will get a lot of volatility both ways in the course of the coming days and possibly weeks, because this isn't going to really improve, actually, as part of everything else, until the dollar turns around. That's part of it, but also until people start to be more confident about what's happening to the management of the UK economy. So it's tough.
You published earlier this morning, and you put this chart in there, and it's just this massive divergence between the gilt treasury spread and what's happening with sterling. Kit, why is that important, and what does it tell you?
Well, it tells you this is a loss of confidence, at least to some degree, in policy, because normally, President Reagan and Paul Volcker managed to put rates up an enormous amount and ease fiscal policy dramatically and sent the dollar to the moon. At one level, the UK Chancellor and the Bank of England did the same thing and sending it, to the floor. And so that tells you that what is here is a crisis of confidence, which, if the economy holds and things hold together, which is probably what happens in the long run, that'll provide buying opportunities. But you can't solve this crisis of confidence overnight, and you need to be careful how you manage it. If the Bank of England comes in this afternoon and raises rates again, for example, would that add to the sense of panic, or would that calm things? I suspect that we have to go through more fear in the short term before anything else happens. And the other piece to it is, we look at it all which ways around. Why are bond yields rising? They're rising everywhere. The US Treasury market's pushing higher. The UK is just going more. Why is the pound down? Everything's down against the dollar this month. The pound just is a wonderful candidate to be the currency that's most beaten up because of this loss of confidence in policymaking.
Okay, but John and Tom were asking about this earlier. Does that make what we're seeing orderly or disorderly?
becoming, well, disorderly. It's becoming slightly more chaotic. This to me feels very much like, you know, the beginning of the final chapter of this dollar move, because we've got volatility levels spiking up so much in so many different assets, but also because the equity market's rolling over. So I think this is the back end. Disorderly, yes, because this morning's moves were disorderly in a thin Asian market. Let's see how it goes. But you know, that's kind of self-evident. That doesn't mean we can't go lower before we're done, and it doesn't mean that you can put order back into this market very easily.
So, Kit, you just said that it appears that this is getting disorderly in the final throes of the dollar's dominance. What does that mean? What's the reversal? I mean, is it a sharp devaluation of the dollar? Is it just sort of a normalization in terms of FX volatility?
I think we'll see. I mean, again, don't get me wrong. I think this plays through the fourth quarter of this year. So, you know, I think, but I think it means that, let's go this way. I think at the minimum, the dollar is going to be weaker at the end of next year than it is today. And I'll put it in that kind of time frame. So I'm not getting myself excited. I think that we're at a level where, you know, if I bought 10-year notes today, I'd probably be okay in the long run, but I'd suffer some more pain between now and Christmas. If I bought the pound, the same thing. So it feels to me as if, you know, certainly monetary policy in the States is working in the sense that all asset markets are reacting. Oil prices are lower, equities are lower, the whole curve's priced higher. The curve's priced sufficiently higher for longer that it's going to do its work. And so we'll get that in all of these countries coming through the system. But that doesn't mean it's easy to trade the next month or two.
Okay, just quickly, if the Bank of England did come out today, what could they possibly say?
I think all they could say, I mean, if they do anything, I would be very, very surprised if they intervene in the foreign exchange market. The UK deliberately doesn't have a large stash of foreign exchange reserves and is a big believer in the idea that unilateral intervention isn't terribly productive. Right. So they can bring forwards the rate hikes that are coming, the next one on the 3rd of November, if I've got my dates right. Maybe if they were going to do 75, they could talk about doing 1%, but now to kind of front load some of the rate hikes to send a clear message. I don't know if front loading your policy tightening, just to go to sound tough, makes a huge amount of difference when what we have is this, you know, fiscal easing on one side, monetary tightening on the other side. Do they work together? What are these guys up to?
Kid, I just very quickly here. I just did a fancy study you can do in the Bloomberg of the Bloomberg Financial Conditions Index for the United Kingdom. There has been a 4 standard deviation move accommodative off of all this policy when you put the secret sauce into the index. If the Bank of England moves, they don't get back to where they were. How far back do they take away the new accommodation if they make a move today or tomorrow?
They take some back. They also change the nature of it because the Bank of England accommodates, so it takes back the accommodation that you've given through a weaker currency and easier fiscal policy by raising the cost of borrowing. So these affect different bits of society, different bits of the economy. So you kind of scramble everything up a little bit more. I don't think it alters the fact, though, that the UK economy is heading into, if not already in, a recession at this point of time, despite phenomenally tight labour market. And that's part of the challenge. You'd like more growth, but you need more slack in the economy if you're going to defeat inflation. And these kind of policy messages from all sorts of angles, it's very hard to sort of sum it all up in just one financial conditions index. But yeah, no, they're not going to get back to the same financial conditions as they had before unless they can get sterling to go back up, which would be lovely, but isn't going to happen that way.
Hey, Kit, thank you. It's good to hear from you. Kit Jukes there of SocGen. What a wild time in foreign exchange with the dollar absolutely dominant. Futures down 5 or 0.6% on the S&P from New York. This is Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think the sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Access the financial world on demand. Policymakers and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you've had your fill of IPOs, ETFs, and CPI,
Tune into the lineup for some NFL, NBA, and MLB.
catch the lineup right here on Bloomberg.
Minutes away from the opening bell. Futures off the lows. We're down 0.5%. Good morning to you. On the S&P, on the Nasdaq, we're down about 0.4%. Yield still higher. Heading north, up 7 basis points, 375.87. Dollar still stronger. Euro dollar 96.54. Unwinding a ton of weakness out of sterling from early this morning. We've gone from like 103 through 107 on cable. David Gura with the meme of the moment out on Twitter. You all know that meme, Tom? When it's the boyfriend holding the hand of his girlfriend, but he's looking the other way as the girl in the red dress passes by him. He's markets. The girlfriend's the Italian election. The girl in the red dress is UK tax cuts. No one's talking about the Italian election this morning, Tom, at all. Just not a feature of the conversation.
Yeah, I think that's fair to say. It is momentous, and it, speaks to what's going to go on in Brussels in that. But it has been overwhelmed. I would say one of the first things I looked at today was the Italian-German spread, just to see if it unravels. I think, John, it's safe to say it did not unravel.
Yields all heading in the right direction, or rather the wrong direction, depending on what side of the trade you're on, Tom. Yields are all heading higher worldwide, with the exception of Japan for very specific reasons.
And again, euro from 105, 112, it'll never go below parity. 0.9653 speaks to what's the next step there as well. Let's get to it. An important conversation with Stephen Whiting, Chief Investment Strategist, Chief Economist at Citi Global Wealth Investments, with terrific experience, and I've said many times, parsing corporate profits, corporate America, into what we expect to see in our economy. Stephen Whiting, how have you adjusted to the new rates of change in foreign exchange and bonds and the real interest rate? How have you adjusted in the last 10 days?
Well, you're either in a defensive position or you're looking at a lot of immediate pain in portfolios that you can't turn the clock back on. We have been adding U.S. Treasuries, not because the yield is some incredibly high, beautiful, inflation-adjusted level, but it's a defensive asset that's probably going to work for a period when the economy turns. And unfortunately, we are heading for a turning point in the American economy. And I think we'll do that quite well below the rates that the Fed is signaling for 2023.
90 days ago, we were angsting about corporate earnings, and I think they did better than good. Someone out there has October 14 as a launch date here. We're a little bit of ways from there, but let's go to your expertise there. Are we going to be shocked again at a resilient corporate America?
Well, we probably shouldn't be. The look back at the third quarter is still going to be a period of rising production, rising inventories. That's a problem for next year's profits, not for this year's profits. What's happened in financial markets and financial profits is telling us where we are headed for the coming year. We would expect about a 10% decline in U.S. EPS next year, again, at a level well short of the Fed funds rate that they are guiding us to, again, to try to maximize the impact, to sort of pull all hope away from the notion that they might pivot. But if you take a look at what the Fed is forecasting, the unemployment rate to be about a half point within this range for the next 3 years, we think it's very unlikely. We think that the U.S. is headed closer to 2 million job losses net over the course of next year. And that's, again, if the Federal Reserve will ultimately not continue to tighten through those job losses. But we wouldn't expect them this year, right? The lags between where the economy, again, started to absorb these rate hikes and where it is right now, it's not going to be immediate. We would expect non-farm payrolls to grow through the rest of the year. And just one really simple example. If you think about what's happened to the monthly pace of new home sales, it's down 51%. But home completions, spending, construction spending, or even employment in residential construction, it's down 2% in the new cycle high for employment. That's because we were building houses and starting these projects a year ago at a lower interest rate level and a higher sales pace. So these are the types of things that have to work through the economy. But forward-looking financial markets should be focused on next year.
Stephen, where are we heading in terms of the new normal? Are we heading toward a rebound, the likes of which we haven't seen in 2009 at some point, if the Fed does shift gears or if there is some sort of washout event? Or are we heading toward a lost decade of profits where you get basically leadership meandering from one area to another and not from big tech?
What I would imagine is that we can have a cyclical recovery in 2024. Right. Unfortunately, we've simply run a pro-cyclical monetary policy with the help of fiscal policymakers turning COVID into a boom, right? Not having targeted, limited stimulus, giving a boom and then taking it away and driving a bust. These are not the things that sort of drive economic growth for a 10-year period of time. Again, it's some really rough elbows here from policy. But it's not going to, again, stop innovation. It's not going to stop any of the things that drive economic growth in the long run. Just take a look at 2002. That was a period in which the NASDAQ fell 78%. But some of the key innovations that drove growth over the coming 20 years were literally invented at that time. Apple's iPod, iOS, these are just examples of things that moved the trillion-dollar economic gains for years and years to come.
And I'm sure that Tom will pick up on this, and he's been talking a lot about this adapting, the adjusting, the innovation. On the flip side, there's also the social aspect overlaid on top of this, especially as inflation starts to bite into the lower and middle income Americans and globally. And we're seeing that in elections. We're seeing that in a lot of the strikes and the uprisings. How do you price in political risk at a time when it's really coming to the forefront?
Well, it's not terribly easy, and usually these types of political risks, in 9 out of 10 cases in the last 80 years, have not been turning points for the world economy. They matter a lot in terms of driving local, regional crises, but they don't really turn around the world economy. Now, unfortunately, there is a lot of bad news to absorb here. And markets could have seen more of this coming, perhaps. They may overreact to this. But ultimately curing inflation at what we expect will end up being, unfortunately, a good deal of cyclical economic pain, right? It's going to come at the expense of the labor market. But we're not going to have long-term inflation instability, right? That's what I think one of the messages that we're going to see. So we're going to end up interest rates peaking at a relatively low level. Unfortunately, we had to go through a boom and bust cycle. But whether you can feed that back to a particular political outcome that's going to change the economy, all we can do, again, is have some safe assets in our portfolios in that event.
But then looking at the Citigroup platform, and you guys have been phenomenal with Hollenhorst on the Fed call and all that. Stephen Whiting, when does the United States not ignore what's going on internationally? When is the point where it becomes like what you and I studied in the 90s, where, I'm sorry, international matters?
It could take some time. Unfortunately, the Federal Reserve is focused very much on lagging economic indicators. In fact, domestic services price, core services, again, have got a power to them. They are a component of the index of lagging economic indicators. And if you just focused on, well, 2%, we need that 2%, well, we could be deep into a recession before we see 2% on these measures again. And so these effects from around the world, we think, will compound against some of the downward pressure on the economy, downward pressure on prices. We don't expect every CPI reading to look like August on the core going forward. But it's going to be a while before you really see that in the economy. So patience, something that central banks told us to have for a while, they've run out of it. And it would be a good time for us to realize that again. The one thing that we heard out of Chairman Powell that was really it was a minor point at Jackson Hole, was that it's going to take some time to get inflation lower. And if they try to achieve it very, very quickly, we're going to end up with a much worse cyclical trade-off, more than is necessary.
I'm going to feel some pain along the way as well. Stephen Whiting, thank you, of Citi Global Wealth Investments. I have to say that things are settling down a little bit now this morning. Futures are down 0.5% on the S&P 500. In the FX market, sterling almost unchanged on the day against the US dollar. Euro dollar 96.68, only negative 0.2%. So some of that dollar strength, we fade that just a little bit. At the front end of the yield curve on a 2-year, we were through 430. Back down to about 426, up on a session by 5 or 6 basis points, but certainly settling down, Tom, in the last hour or so.
Yeah, it is. I'm going to signal it as the Bank of England rumors. John, is that the right word? Speculation?
Yeah. I think speculation.
Yeah, but I would say that was the hallmark, is people wait and they're trying to adapt to adjust to what we could see. My opinion doesn't matter here, John, but they've got like a choice set. That's all there is to it. Do nothing, jawbone it, do something tangible, say they're going to think about doing something tangible. Or wait.
And
wait is their best friend.
The next meeting, at least for a while away, start in November.
If market's already pricing in 200 basis points of rate hikes, why not let the market do what it's going to do and not weigh into the political regime? And that seems to be what some people are saying. So if they do come out and say something and they do raise rates, what kind of political bullseye are they putting on their backs? And if they don't, well, the market maybe will move away from what they're expecting. We'll have to see.
I say things are a quieter day. Quieter, not quiet. If you're looking at the UK 2-year up 51 basis points and a 10-year up 28, I mean, still a meaningful move, Lisa.
Yeah, and this really goes to Kit Jukes' point. Are we seeing the beginning of the end of the dollar bull run? Are we seeing the washout kind of phase of some of the peak hawkishness? I hear grunting going on outside of this.
Is that grunting or growling?
Growling, grunting. He doesn't growl. He's not a bear, but he does grunt because, that's what we do here. But I guess I'm just, we'll have to see. Maybe peak hawkishness didn't really work a couple months ago. Will it work now?
TK, you were the only one that didn't send me ice cream over the weekend. AMH sent me Van Leeuwen 3 tubs of the stuff. Got some from St Ambrose.
The case of Jenny Cream Ale got lost in the mail.
You're the only one that did send me ice cream.
He's being paid in pounds now.
I know, seriously. Come on. Donate to the tooth pain.
You doing all right?
No.
What you can do, John, is you can take an ice-cold Narragansett lager beer and hold it against your cheek.
That would be that, and then drink it through the show.
This isn't working for you to
ease
the pain?
This isn't working out. Priya Misra, she's going to ease the pain later with Jim Bianco and Tony DeSpirito. They're going to count you down to the opening bell in just a moment. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Bank of England hasn't decided whether to make a statement following the collapse of the pound to its lowest level ever. Conservative lawmakers say the central bank may need to step in to halt the panic. Some believe an emergency interest rate hike is likely. In China, the Communist Party has reaffirmed President Xi Jinping as its core. The party published its list of almost 2,300 delegates to attend next month's leadership summit. The announcement brings Xi a step closer to clinching an unprecedented third term in power at the event. Initial sales of the iPhone 14 in China were smaller than the device's predecessor a year ago. That's according to a note from Jefferies. The firm says 987,000 units were sold in the first 3 days, an 11% decline from comparable sales of the iPhone 13. Credit Suisse says it's working on possible asset and business sales. The Swiss bank is looking for ways to cut costs and restore profits under a strategic plan to be announced next month. No details yet, but Bloomberg has reported that Credit Suisse is considering the sale of its Latin American wealth management operations, excluding Brazil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
our forecast certainly is a challenging one because we are forecasting a significant slowdown of the economy to, say, the United States growing at 0.5% next year, the euro area growing 0.3%, and still a slowdown in China this year, next year recovering a little bit, but still, globally, we're talking about significant slowdown.
The OECD acting chief economist, Alvaro Pereira, it's good to hear from him here. And this is, of course, oil moving downward, 78.62, down 37% from the panic of $120 a barrel. Lisa Bramlett, Tom King, Jonathan Farrell getting ready for the 9 a.m. effort. And right now, and this is a joy for me, long ago and far away, we had to reopen our San Francisco offices, a beautiful platform down in the Bay. And they said, we want to do an event. And they said, who should we get? And I said, there is only one name on the West Coast that intellectually lights it up each and every day. He had a website, Slouching Towards Utopia, and his name was Brad DeLong, professor of economics at Berkeley. Finally, and I mean finally, we have his 500 pages, Slouching Towards Utopia. And what I really want to emphasize here before we bring the professor in, this is a book for conservatives. It's a book for the liberals love it. I get that. His PhD advisor Summers at Harvard and all that. But more importantly, this is a book for conservatives going, what the hell happened? Brad DeLong joins us in celebration of Slouching Towards Utopia. Brad, you mentioned fascism 7, 8, 9 times within Slouching Towards Utopia. Italy, the shock today, Hungary as well, what the United States has been through over the last X number of years. How close are we to Mussolini?
We're still quite far away from Benito Mussolini. We're still much closer to, say, someone like Andrew Jackson, who stole a third of the land in North Carolina from the Cherokee and sent them off to Oklahoma, or similar politicians who are find internal or external enemies and focus people against them as a way of trying to deal with the fact that they really cannot handle managing the economy that they've been given.
If middle liberals or middle conservatives read Slouching Towards Utopia, what is your prescription to get the middle of our political economics back in control of the voice, or is it further polarized America forward?
Well, we never have had control since 1870. Sometimes, however, we've been extremely lucky. Right? That is, since 1870, for the first time in human history, the value of human technology has been doubling every generation. And governments have been kind of unable to ride this particular Schumpeterian creative destruction tiger, largely because governments have been looking backward, and yet each generation, the technological underpinnings of the economy are so different that successful economic policies have to be different as well, that what worked a generation ago no longer works. And what you can cobble together now won't work in a generation.
Brad, we're looking at a rearranging of order in a lot of ways economically with the end of the zero rate world. And we're seeing the beginnings of a reordering or a push to reorder things in a political regime. What is going to be, from your perspective, the defining feature of the next decade politically with some of these policies as they try to move away from concepts of modern monetary theory? You can't just print money endlessly. Inflation's back, a real thing. Where does fiscal support play a role in this?
Well, in the United States, I suppose it really depends on whether Jay Powell and company realize that all of the tightening of financial and monetary conditions that happened last winter and spring have not yet hit the economy, right? That is, there is a lot of monetary contraction and austerity coming down the pike that's not visible in the data yet. If they are calm and patient and recognize that they've already done a lot more to cool off the economy than they currently see in the data, then we might actually manage to make our way through. If not, then not. And certainly the width of the strait between the monsters Scylla and Charybdis, that there was kind of a wide path to go through last November, even last December. But come February and Vladimir Putin, all of a sudden the kind of strait is very, very narrow. and the ship may not be able to sail through it. Indeed, there may not even be a strait at all left.
How optimistic are you about the nodes of potential improvement, given that all of the tech has not been able to create the utopia that you or a lot of people thought would occur once some of these developments had gone into place?
Well, you know, it is absolutely flummoxing, right? That humanity's technological prowess doubling every generation since 1870. That means for the first time in human history, we can actually bake a sufficiently large economic pie for everyone to have enough. And, you know, utopian thinkers of all previous centuries thought that once you could get everyone enough,
right,
all of a sudden a huge amount of the nastiness would fall away from human governance. And yet killer robots still stalk the skies above Ukraine and Syria.
Brad, I got time for one more question as we celebrate slouching towards utopia. There was a professor at Berkeley, his name was Chad Jones. He went to another school across the bay. I can't remember what it was called. Chad Jones owns basic economic growth. It has failed so much of America. Jeff Sachs is encyclopedic on this. Where's the optimism we can develop to take half of America not participating and bring them back into the fold? What's the DeLong prescription?
Well, it's to recognize that we've been trapped here in this world since 1870, in which each generation technology races forward at an unbelievable rate. And each generation, a huge number of people are left behind. You know, the Midwestern farmers who supported William Jennings Bryan in the 1890s, et cetera, et cetera. To simply recognize that this is not a new problem, but this is something that we have been grappling with and failing to deal with since 1870, will at least let us see our current situation in perspective.
Brad, we got to leave it there. Brad DeLong out, and I can't say enough, folks. The thickness here on radio, all you need to know is it's got the DeLong depth to it here, slouching towards utopia. And again, I want to make
it clear. It's a transoceanic book. It's a transoceanic book. It's not a flying around the East Coast book.
Yeah, it is very transoceanic, and also it's something that you have to read. And what I'm going to say, my 2 cents on this is simple. It's a book for conservatives. I know none of them believe me here, but DeLong has written a book on our economic history that's really quite extraordinary. Slouching towards utopia. Utopia is out there, Lisa, somewhere, isn't it?
Well, we haven't gotten there yet, and that, I guess, is the message, despite all of the innovations and despite the fact that we have enough. And this is going to be a really important point because we have a fascinating moment that we're in with collective rate hikes, with a rethink of inflation after years where it was more abound.
John Taylor comes in from Palo Alto. Thank you so much, John Taylor, for emailing in. He says, Jones is at a school called Stanford. It was good to clear that up. Professor Taylor, thank you so much for clearing that up. Markets, more markets through the morning. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this, you got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the Moselle.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Trying to stage a recovery here, just about flat on the NASDAQ. What a turnaround from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, the sound of the bond bubble bursting.
We've got a new world now.
Yields are attractive.
You can actually get something of a return on bonds.
There's a lot more value in this market than there was a year ago.
You're probably closer to buying bonds than stocks.
There is an alternative right now.
Here, there is an alternative, and that's the front end in yields.
One good reason to be bullish.
Baskets of bonds yielding 3.5% to 4.5%.
The bond market should play a good role in a portfolio.
The Federal Reserve can and will speak very hawkishly going forward.
There is no Fed put with an inflation rate with an 8 handle.
Rates seem to be driving the bus.
Policymakers wish they can use a scalpel. Instead, they're using a sledgehammer.
This is a global game.
Let's talk about that global game. Joining us now is TD's Priya Misra, Jim Bianco of Bianco Research. Priya, the carnage in the bond market. How much worse can this get?
So I think we're in the midst of a repricing, I think a pretty big VAR shock in an environment where liquidity is not great. So trying to call the top in yields is tough. Inflation's high. I think the Fed is telling us they're on a mission here. So, you know, the front end, I would say I'm staying away from that very front, the 0 to 5 year part of the curve. I do think if inflation, which is sticky, the Fed here is not letting the lags or is not willing to tolerate high inflation to let the lags play out. I think could the terminal rate be higher? We actually revised up our terminal rate to 5%. So that front end can certainly move higher. I do think the long end has value. I mean, given the volatility, UK rates move 50 basis points overnight, it's going to have a spillover in the US. But I think if you look at real rates, our view is that those real rates now are going to start to constrain growth. So, I think 3.5% to 4% on 10s is it's going to be unsustainable for the US economy to handle that high long end rates. So that's where I see value right now. But, trying to call how high it can get with the market moving this much is tough right now.
Priya, you've broken it up quite nicely, the front end and the long end. So let's do that with Jim. Jim, the front end, we're repricing terminal rates everywhere. The Bank of England, we're looking for something north of 100 basis points through November, potentially. The ECB, we're now pricing another 75 basis point hike in October. Jim, do you assume that's still the direction of travel, that we're going to keep on repricing terminal rates higher into year end?
Yeah, I do. And as a matter of fact, the UK market might be looking as high as 200 basis points of yields on the front end by November. It has been stunning, the move that we've seen. The problem is nothing is broken. Now, financial markets are cracking left and right, but economies don't seem to be cracking, at least yet. Look at the United States. We've got a trend down in unemployment claims. We've printed 300,000 jobs every single month this year. We have very few signs that the economy is cracked. So without that, there's nothing to constrain the rise in yields. They'll just keep going up. The Fed will keep talking hawkish. They'll keep worrying about inflation until we see the economy crack. And I'm trying to differentiate that from the financial markets, which are cracking. You're going to continue to see that terminal rate creep higher. You're going to continue to see interest rates move up, and you're going to see financial markets stay under stress.
So, Jim, you're on the same page as Priya on the front end. What about the long end 10s? Priya's point here generally is that it's difficult to live with 4 to 5% interest rates over an extended period of time. Jim, do you agree or disagree with that?
I completely agree with that, but I would put a fine point on it that an extended period of time would be years, that if you were to get to 4% or something above that for a period of months, I think the economy can handle that. But if that is going to be the new equilibrium rate where we kind of settle out and then we see rates vacillate around that, that will be a big problem for the economy with the amount of debt that we have and the coming repricing of debt service higher to those type of levels.
Equity futures right now down about 0.4% on the S&P. We're about 26 minutes away from the opening bout. Can you just spare a thought for anyone who's got a trade cable? Sterling against the US dollar, basically unchanged on the day now. Can I just give you the range? The high was 109.31 in the last hour. The low was 103.50 overnight. That's just the intraday trading range, and it's only 9 a.m. Eastern time. As for the global bond market, Treasury yields right now, they're higher. They were much higher this morning. They're up by 2 basis points at the front end, 422 on a 10-year, 373, up around about 5 basis points. Bank of America put out a note on Friday. Global bonds on track for the worst year since 1949. It has been that bad, that vicious, and we still have 3 months and change still to go. Katie Lights has more. Hey, Kaylee.
Yeah, John, it's continuing even this morning, and that is not just a U.S. story. A lot of it in the last 2 days originating in the U.K. as fiscal policy, the idea of tax cuts and more borrowing in order to fund all the spending has driven gilt yields absolutely bananas. On the 2-year gilt yield, we're up more than 50 basis points on the day after a move of a similar size just on Friday. So we've already moved about 131 basis points over just the last week. And of course, at the longer end of the 10-year gilt yield, up about 92 basis points, and that has fed through the rest of the world, with treasuries up about 24 basis points over the last 5 days. This is actually the first time in 8 years that the 10-year gilt yield is above that of the U.S. Treasury yield. And on the subject of treasuries, I would note that with the moves we have been seeing, we have meaningfully broke out of a long-term trend. The 35-year downtrend in 10-year rates has turned around, and now it is back an uptrend, skyrocketing on the 10-year, up 200-something basis points so far this year. And with it, the bond bull market has come to an end. Global bonds are actually now down 23% from their peak last January. And while that may make it seem like bonds are a bad place to be, it still might be a better place to be than stocks. Maybe Tina is now actually dead, because if you look at the S&P 500 dividend yield versus the 10-year Treasury yield, back before the COVID-19 pandemic, it was 2.9% on that dividend yield relative to just 70 basis points on the 10-year Treasury. Today, we're talking 3.8 on the 10-year Treasury, 1.9% on that 10-year dividend yield. That is a gap of about 200 basis points, and the widest gap since 2011, John.
What a change in the last 12 months. What a change in the last couple of months. Kaylee, thank you. Jim Bianco of Bianco Research, still with us. Jim, we've just blown up a decade of zero interest rate policy, a decade of it, of QE, trillions of dollars of negative interest rates. And Jim, you and I, Priya as well, we're all trying to work out whether we ever revisit that, whether any of that actually sticks. Do you think it does?
Yeah, if you're talking about going back to zero rates, I don't think, at least in this cycle, we're going to have to run through an entire cycle, probably 1 or 2 recessions, and then maybe the economy reorients itself and we could visit the idea of going to zero rates. But for right now, I think it's pretty obvious that the 35, 40-year bull market in bonds is over. We're in a period of higher rates now. How much higher and how long it's going to take would be the debate, and that really depends on where inflation peaks, how low inflation goes. Does it settle out at 2%, or does it settle out at 4%? But I do think if anybody's hoping for those period of the pre-COVID period where the market goes to zero, the Fed prints money, and everything rallies because we've got liquidity sloshing around in the system, I think that is a bygone era right now.
So, Jim, what do you think will break the positive correlation between bonds and stocks? Because surely this doesn't hold indefinitely.
Well, it already is breaking to some degree. If you look at the shorter-term correlations, we're at a 15-year high. We've seen the price of bonds and the price of stocks move together to the most that we've seen basically since 2007, and any wealth manager that's managing a 60-40 portfolio knows this painfully well because both their stock and their bond portfolios are falling at the same time. Typically, when that happens, you get that positive correlation. It's in a period that people are worried about inflation, and we're in a period where people are worried about inflation. So what ends that? If we end the period of worrying about inflation, well, we might peak inflation soon, but that doesn't end the worry. The worry might come years later. So it's going to be a while, I think, before we see stocks and bonds revert back to what we saw between, say, 2000 and 2020.
Britt, can I get your thoughts on that? Because I think that's absolutely critical for a lot of people in this market at the moment. When do the risk mitigation characteristics return to bonds in a way that equities are lower and bonds actually appreciate and yields drop? Because at the moment, the epicenter for the pain, the poison, is the bond market, leading to lower equities. When do we break that correlation?
So I would say it's inflation to Jim's point, but also growth. You know, at some point it takes a while. Monetary policy works with a lag. But are we talking 6 months from now? The unemployment rate starts to rise. That's when I think you have to revisit correlations because the Fed may not be able to respond. So the front end will not provide you any hedge. But what about the long end? Because at some point, inflation comes down. It just takes a while. Growth slows down, starts to put downward pressure on wages, that then starts to impact CPI. Maybe it's a year out, and the Fed starts to cut rates. In our view, they're going to be cutting rates pretty aggressively in 2024. But how do you set up for it now? The market's forward-looking. So I would say the long end starts to provide that hedge the moment you start to see the economy slow down. So it's not just inflation. I think inflation's more about the front end. You have to pick your points in the bond market. You know, is it credit? I'm a little nervous about credit risk premiums here because the debt servicing cost starts to go up. I would say it's government bonds in the long end that start to offer value against risk assets, because we know growth is still going to respond to that move higher in real rates. And I don't think the bond bubble in real rates is over because that's a function of demographics, of productivity. We haven't seen any of that change. Even if your inflation expectation and risk premium is higher, the real rate bond bubble is, I think, very much still here because these are very structural forces at play.
Priya, that is so important. Jim, can I get a final word from you on that real rates could remain suppressed?
Yeah, I mean, they could remain suppressed. And keep in mind that if you go back to 1954, every cycle where the Fed was hiking ended with positive real rates across the entire yield curve. Chairman Powell mentioned that last week in his press conference. Now, he's using core PCE, so he's using a 4.8% inflation rate, and we're nowhere near that across the entire yield curve. So if the idea is where do real rates peak, it isn't here. It's probably going to have to be much higher before we finally see that end, at least of this cycle.
Jim Bianco, Priya Misra, sticking with us. Shout out to Chris Harvey today as well. Chris published earlier this morning over at Wells Fargo. I've said this a million times, nothing wrong with being wrong. Chris is coming out and saying it. We've been wrong. He said the following: our belief that we wouldn't retest the 22 low until the first half of 23 was wrong. Despite retesting the lows, we feel the market bottom has not been established and stocks will make lower lows in 23 as EPS estimates come down and the Fed tightens into recession. It's that next shoe to drop that Mike Wilson and Morgan Stanley's been talking about for a while that we'll focus on with Tony DeSpirito of BlackRock a little bit later. Coming up on this program, UK assets selling off in the wake of new fiscal plans.
Now we have that reaction in global financial markets to the irresponsible and reckless statement that we had from the Chancellor on Friday.
Sterling has had an absolutely wild ride today alone. That conversation up next.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
What I'm determined to do as Prime Minister, and what the Chancellor is determined to do, is make sure we are incentivising businesses to invest, and we're also helping ordinary people with their taxes. And that's why I don't feel it's right to have higher national insurance and higher corporation tax, because that will make it harder for us to attract the investment we need in the UK. It will be harder to generate those new jobs.
The UK's latest fiscal measures fueling volatility in risk assets, gilts plunging, the pound taking a wild ride after touching fresh record lows early this morning. The Shadow Chancellor weighing in.
That's not what financial markets want to hear. They want to hear that the Chancellor has got a serious plan for getting a grip of the public finances. We didn't hear that on Friday. We didn't hear it over the weekend. And now we have that reaction in global financial markets to the irresponsible and reckless statement that we had from the Chancellor.
My good friend Guy Johnson joins us right now from London. Guy, the range on cable, the high today, 109.31, the low 103.50. What on earth?
I think the range is explained by the Bank of England, John. You can almost feel the energy emanating from the building over my left shoulder. They have a challenge now. What are they going to do in response to what we're seeing from the market? The market, John, is pushing. So you get the thin liquidity in the Asian session overnight. The pound plunges, continues basically the move that we had out on Friday into the weekend. So we reopen in Asia in the Asian session. Low liquidity goes down sharply. Then markets start pricing and pushing the Bank of England. And that is what you're seeing in cable right now. You are basically seeing the market beginning to price what we're seeing in the gilt market, which is the Bank of England responding. And we've seen throughout the morning, headline after headline after headline. The market is now pricing the Bank of England to do X. Now it's X plus 1, now it's X plus 2. The market is pushing the Bank of England. How does the Bank of England respond to this calmly? How does the Bank of England respond to this without looking like it's panicking? That, I suspect, is the question that is being asked and hopefully answered over my left shoulder at the Bank of England.
Guys, the domino after that interests me a whole lot more, and I know this is tremendously difficult to game out. What we've got here is the spiral that follows. You've got looser fiscal, which means tighter monetary. I'm trying to work out whether that means looser fiscal after that, and what the response of the government would be if the Bank of England validated what is currently priced.
So that I think is what changed over the weekend as well. You heard from the Chancellor, and the Chancellor seemed to imply that further tax cutting could happen. Now, would that further tax cutting happen in response to the Bank of England stabilising and the kind of spiral that you're talking about? But he certainly threw a little bit of extra gasoline on this fire over the weekend by suggesting that he is not done and that spiral could continue. The other challenge the Bank of England has as well is that if it were to curtail its QE, would it look like it is helping the government out and therefore effectively financing indirectly what the government is proposing? Huge questions for the Bank of England.
Massive debate right now, Guy, that we're all having with our guests on whether what we're seeing at the moment is just the required adjustment through higher yields and a weaker currency to attract capital to finance a big deficit, or something disorderly. the beginning of a self-fulfilling downward spiral as such? From the people you speak to, Guy, is it the former or the latter?
I don't think we know yet, but the balance is beginning to shift, isn't it? This doesn't feel orderly at this point. You haven't seen these kinds of moves for a very long time. As ever, John, the adjustment is one thing, A to B. It's how fast you get there, I think, is the real critical question. There is an argument to be said that this is a country that needs maybe a lower tax burden to encourage a more vibrant economy. Now, that's just the first step on a journey, but maybe that is required. But you are trying to introduce that into a fairly febrile market right now. We know that, which is why this becomes more challenging. So it's the scale and the speed of response, and I think it's the latter that I think is really interesting. This country clearly does need to make some changes. I think a lot of people would agree with that. How you do that and how quickly you do that is the question here. And I think that is what the Bank of England is going to be looking at very carefully. It's not necessarily the ultimate journey, it's how fast it takes the country to get there.
Hey, Guy, always great to catch up, buddy. Looking forward to the coverage in about 41 minutes' time. Guy Johnson and Alex Steele are going to guide you through the close, the European close, and pick up on this story as well. Priya Misra, can I throw that question at you? It's kind of the important one right now. Are we seeing just a required adjustment through higher yields and a weaker currency to attract capital and finance this deficit? Or are we seeing something disorderly, some kind of self-fulfilling downward spiral?
I would say right now it seems very disorderly. Depending on how the Bank of England responds, they will determine which way it goes. You know, if there's a sign that they're not independent, they're actually facilitating this move, I think it becomes disorderly much faster. And, you know, at that point, you have to sort of question the independence of the central bank. Are they committed to the inflation target? I mean, this is a giant experiment that the UK is undertaking. And is the Bank of England going to be an enabler? Or, you know, are they going to fight it? I think the gilt sales that are supposed to start next week, I would argue it's very hard for them to say that they can sell in a market. It's going to get much more disorderly. So I think, you know, maybe postponing it by a month, that is something we do expect that they do. Some sort of verbal intervention, that they're there to support the market for liquidity. You know, I think all that we get. Anything larger and no, you know, or rather a pushback on intermediate hikes, or even if they don't do an intermediate hike, pushing back on that terminal rate, I think will make the, you know, I think that's when that downward spiral accelerates. Right now, we're still waiting to see. I mean, they just had a meeting last week. I have to think that the Bank of England had an idea of what the fiscal side was doing. They still went with, you know, 50, not 75 basis points. So I think they might be trying to just gradually raise policy as opposed to, you know, act like they're facilitating. But any sign of facilitation or that they are working together, I think does take this to another level.
Priya, how well understood do you think the gilt market actually is? Given the average maturity is 15 years, the debt pile is dominated in sterling, how well understood do you think that is?
Right. I think which is why the gilt sales were necessary, because just passive runoff, what the Fed is doing, was not possible. But the UK market's also very much a domestic market. The pension funds are very large holders of long end paper. I'm sure they're now questioning, you know, where do gilts end up? I mean, if you have high inflation, high fiscal, I mean, the government's talking about tax, about spending cuts. But in an economy that's in recession, I think you have to question whether they'll be able to get these, you know, spending cuts done next year. They didn't align the tax cuts and the spending cuts, and I think that is going to make people question long-term, where should these gilt yields be? And I think that then has ripple effects across asset allocation within the UK. So it's a less liquid market, I have to say. We're getting used to seeing very large moves in gilts. So it is a different market than bonds. But there are big spillovers between what happens in gilts and bonds and treasuries. So I think we should all be paying attention, even if you are not involved in the gilt market.
Jim Bianco, I wanted to give you the final word. We've heard repeatedly over the last week, this is a big risk. It's an experiment. Why is it the wrong one?
Well, because the UK has an inflation problem, and the Bank of England came out in August and said that in Q4 they would be in recession. Now, Q4 is Saturday, so I guess we're in the final week of not recession in the UK. And now that they're going to cut taxes, cut regulation, you're going to inject massive stimulus into the UK economy. Let's assume that works. Let's assume they get what they want. That portends much higher inflation. that portends more volatile markets as they try to adjust to the idea that the inflation rate is going to ratchet even higher. And so we're in for a thrill ride. You know, you asked if the markets were disorderly, and I agree with Priza that last week, no, this week, maybe, that they are, you know, on the way towards becoming a lot more disorderly.
I say things have settled down. Intraday, the 2-year in the UK is still up about 50 basis points, so still seeing some major moves. Priya Misra, Jim Bianco, to the two of you, thank you. Sterling, just about unchanged. Up next, the morning calls, and later, Tony DeSpirito of BlackRock. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
To 5 minutes away from the opening bow. Futures just about recovering, down 1/3 on the S&P. That's the price action. Here are your morning calls. First up, Raymond James upgrading Planet Fitness to a strong buy, citing its defensive business model and attractive valuation. UBS downgrading Lyft to neutral, $16 price target, seeing better opportunities and greater upside in shares of Uber. And finally, Wedbush cutting its Micron price target down to 65 a share, expecting softer global demand to weigh on its upcoming results. That stock is up by 6.8% in early trading. Coming up, the VIX hitting a 3-month high. BlackRock's Tony DeSpirito recommending investors own selective growth and value stocks to overcome the volatility.
A landmark climate bill passes through Congress. The expansion of nuclear energy and more investment for companies at the forefront of the fight against climate change. In this episode of Bloomberg Green, we'll explore President Biden's climate bill.
I almost think there's no superlatives that capture the breadth and scope and scale of this law.
Find out what's actually in it and where it doesn't go far enough.
The thing that's not included here is a specific hard cap on CO2 emissions or a specific legislated goal.
And look at what more needs to be done to invest in modernizing and greening U.S. infrastructure.
What we haven't had is a plan that's realistic, time-bound, pragmatic.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. With a major energy crisis and possible recession looming, Italy heads to the polls. Keep it tuned to Bloomberg for up-to-the-minute results and analysis of what it all means to you. Bloomberg, your global business authority.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bell. Good morning to you. 4 straight days of losses on the S&P 500. Will it become 5? Futures down about 0.4% on the S&P. On the Nasdaq, we're down about 0.25%. On the Russell, the small caps, negative 0.6%. The opening bell in New York rings. Switch on the board and get to the bond market. Yields higher on a 2-year for 13 straight sessions. On a 10-year by 6 basis points on the session. On the day, the 374.27. 12 months ago, the 2-year, about 20 basis points. This morning, 4.23, and had a little look at 4.30 earlier in the session. Massive change. Euro dollar negative 1/3%, 96.54. Dollar strength still present through much of G10. Sterling was down and down hard to about 103.50. It's bounced back to 109. Just short of that at the moment, 108.20 on cable. So big turnaround there. About 30 seconds into this one, let's get you some movers. At the opening bell is Abby.
Well, yields up, stocks down. That is a story once again. A little bit more of a muted version of that than what we were seeing earlier in the pre-market when the S&P 500 E-mini futures were down 1%. That 2-year yield was up 14 bips, now up 3 bips, but still super high, 424, as you were just mentioning, John. That, of course, means that Apple, it's off of its 1% lows. Right now, perhaps about to flip even. It's down just fractionally. Wells Fargo, interestingly, the bank's not getting a bid from yields being higher. That probably has something to do with some of the yield curves coming in, just a little bit more mixed action. Chevron down 0.6% off of its lows as well. This as oil has inexplicably turned around. It's now up a little bit after having been down more than 1%. The big movers, though, might be some of the casino operators. Las Vegas Sands soaring up 10.3%. A bit of a bright spot. This, of course, as Macau, they're said to be allowing group tours back in Macau as early as November, and they, of course, some of these casino operators can receive as much as 70% of their revenue from that Macau region. So again, a bright spot there for some of the casino operators, John.
Abby, thank you very much. And I misspoke a little bit earlier. It was Win that is up and up big. It's up by a little more than 8% off the back of the story that Abby's discussing. About 1 minute and 50 seconds into this, stocks are down just a little bit on the S&P, down 0.25%. On the Nasdaq, we're negative just 0.03%. Ed Ludlow, we're trying to avoid a fifth day of losses.
Yeah, we're flat on the Nasdaq 100. That 5th day of losses would be the worst run since February. Some pain in the mega caps, particularly in Tesla. You're looking at the likes of Alphabet and Apple also being a drag on the index. This is a global story, right? And the story, not just the angst coming out of the United Kingdom, but also what we're seeing in terms of rate expectations in Europe. This is the Bloomberg World Tech Index, on track for its biggest annual decline since 2008. We do focus on the Nasdaq 100, though, because we bring up the next board and look at how the Nasdaq 100 is traded relative to Asia, relative to Europe. The pace of declines has just been greater. That was the focus of our NLive Pulse survey. 914 respondents. 2/3 of them basically say profits in the tech sector are going to disappoint in the quarter ending September through to the end of the year, in the final quarter of the year. But this is what's so fascinating. Where does the Nasdaq 100 go? The majority of respondents, both pros and retail investors, see us hitting a 10K handle, John, not a 14. 1,000 mark on the NASDAQ 100. I keep talking to you about the direction of travel. Really hard to justify calling a bottom in tech stocks when you see that real yield continue to push higher.
Sitting just above the June lows on the S&P at the moment. Good to catch up, Ed, as always. The NASDAQ, the S&P has been a tough time. The transports heading towards their biggest monthly decline since March of 2020. Taylor has more. Hey, Taylor.
Hey, John. So let me talk about some of the individual stocks as well, and then we're going to end on sort of the big transport look and the Dow transport theory. Let's talk about the airlines for one, right? In the midst of sort of the macro headwinds of all of the maybe recessionary talk, there's that hanging in the backdrop, and then there's also some actual real risk when you think about some of the airlines. American, for example, heading into court today with JetBlue to defend a partnership that they have. DOJ and some other states had filed suit against them. So that's sort of that idiosyncratic story. And then there's FedEx. And if you change up the board, we can talk a look about how the transport index have done since that FedEx announcement. Remember, they came out early with the pre-announcement, said that they weren't going to be meeting some of their targets. Then they came out with a real release. And FedEx really on the macro headwinds, citing huge weakness, but also some of that execution risk that you and I have talked a lot about with some of these individual companies, given the weighting in the Dow transports, that has also dragged that index lower. I don't want to say I'm a Dow theory expert. Maybe Abigail Doolittle here to my left can weigh in. But John, when you think about where we are, stocks relative to the S&P 500, we've talked about that maybe being the, quote, new Dow theory. Old, as you know, transports relative to the Dow Jones Index. Regardless of how we're categorizing it, it has been lower and lower, really, again, some of the macro headwinds here on the horizon.
It's the only time we talk about the Dow, for good reason.
I know.
Thank you.
And I'm never, invited back on this show
Of course, you're welcome any time. In the next segment, too, Taylor Riggs is going to count you down to the close a little bit later on. Wanted to talk about foreign exchange as well. Year to date, on foreign exchange, the moves have been absolutely phenomenal. And I can tell you where we are currently because of the bounce back in sterling in the last couple of hours. Sterling's no longer the biggest loser in G10 against the US dollar. That's still the Japanese yen, down by about 20%. Sterling's down by 19.8%. The Swedish currency down by 19.5%. Norwegian currency down by 17.5%. The euro's down by about 15%. The relative outperformer in G10 against the US dollar, the loonie, Canadian currency, still negative 7.3% year to date. Crazy stuff. The S&P 500, very, very close to the year's lows. And the strong dollar this year, Kelly Lyons, has not helped.
Strong and continually getting stronger. I mean, all hail King Dollar, John. It seems to be the only thing anyone wants to buy right now, up against everything in G10. As you said, as there is a narrative that hawkish central banks, specifically the Federal Reserve, particularly the Federal Reserve, are going to keep supporting this dollar, while other central banks hiking cannot do enough to support their currencies. Just look at the euro or the pound for an example of that. And this seems to be the narrative that this isn't going to change anytime soon, that there isn't much standing in the way right now of dollar strength. Obviously, that has big ripple effects, including for stocks, especially those big multinationals that have significant exposure overseas, because the value of the sales made elsewhere is worth a lot less when it has to be converted back into dollars. So those FX headwinds are quite large, and that is something that Mike Wilson over at Morgan Stanley pointed out in research this morning, saying that by his calculations, every 1% change in the dollar index has a negative 0.5% impact on profit. So he said fourth quarter S&P earnings will face an approximate 10% headwind from the stronger currency. That may help explain why S&P companies with low international sales are outperforming those with high international sales, which is that blue line we're looking at here on this chart. Of course, the currency impact is felt in other classes, asset classes as well, including commodities, because those priced in dollars are more expensive for overseas buyers. So that, coupled with demand concerns around a deteriorating growth outlook, has dragged hard on the likes of the metals, with copper down about 30% over the last 6 months, gold down about 16%, and of course, crude sub $80 on WTI. We are at the lowest levels since January, John.
Kelly, awesome work this morning, as always. Kelly Lyons there. Want to pick up on that quote that Kelly just used from Mike Wilson and Morgan Stanley. If you want the numbers again, I'm happy to share them with you. On a year-over-year basis, the dollar index is now up 21% and still rising. Based on our analysis, that every 1% change in the DXY has around a negative 0.5% impact on S&P 500 earnings. As Katie said, fourth quarter S&P 500 earnings will face an approximate 10% headwind to growth, all else being equal. Morgan Stanley's Mike Wilson. Tony DeSpirito, BlackRock, joins us right now. Tony, I'd love to get your thoughts on that dollar call from Mike Wilson and the team and what it means for this equity market. Just how much damage can we expect from this FX market to this equity market stateside?
So, thank you. Good morning, John. So I think the earnings outlook really faces two headwinds. One is what Mike Wilson is citing, which is the strong dollar, and I think that is easily quantifiable, which he has done. The other, quite honestly, is the slowing economy. You know, the Fed started hiking in March of this year with a 25 basis point hike. You know, if you talk to any economist, and any economist will tell you those rate hikes impact the real economy with a lag, at least 6 months, but many would say a year to 2 years. And so we haven't even begun to feel the effects of that on the real economy and hence on earnings. So I do think the earnings outlook is cloudy. Now, the good news is valuations have come down a lot, right? The market started the year with the S&P trading at over 20 times earnings. That's now down to a much more normal 16 times earnings.
Tony, just in terms of how far you would push this out, to your point, the dollar story, easily understood, easily quantifiable. The story you're talking about, the rate hikes, a lot of that means it's already baked in and the slowdown in our future is already guaranteed. Tony, how far would you push that slowdown out through next year?
Yeah, so I think it's really through the first half of next year. Now, the market can react much more quickly than the real economy. So I do think that once the Fed pauses or even pivots, right, that'll be a positive signal for the market. So we as investors have to stay forward-looking, realizing that the earnings outlook is for weaker earnings. But on the flip side, at some point, we're going to get a Fed that has to reverse itself.
Until then, Tony, what on earth do you do?
Yeah, so my recommendation has really been to stay balanced, right? And in terms of that balance, you know, I've been leaning the portfolio I run, the BlackRock Equity Dividend Fund, more towards stability sectors, right, to help ride through whatever earnings hiccup we're going through. Now, there's a challenge there because many of the stable sectors that you go to, utility staples, are very overvalued, trading at 20% premiums to the market. And history tells you, that buying at that level might feel good in the short run, but in the long run, over the next 12 plus months, doesn't pay off. That said, I'm seeing a lot of I see a lot of possibility in the healthcare sector. That sector is trading at a roughly 10% discount to the S&P 500, despite having good long-term growth characteristics, as well as good stability in a recession. And so I'm seeing a lot of opportunity there.
Tony, how much has your world changed in the last 12 months with a 2-year that's gone from 20 basis points to something close to 4.3?
Yeah, look, I think that's what's caused the dramatic change in valuations in the market. The market's gone from, like I said, over 20 times earnings to a much more normal 16 times. So that's really the good news, is that valuations have corrected. But like I said, I think we've yet to see the fundamental impact of those rate increases, and that's what keeps me tilted towards stability.
And Tony, do you need that rate increase to stop going up or come back down to get that kind of enthusiasm back into this equity market?
Yeah, I think the market would be really excited by a pause. And so I think that's really what the market needs.
Let's see if we get a pause, Tony, because listening to Chairman Powell last week, it was anything but one. Tony DeSpirito there. Mislav Matejka over at JP Morgan. And Tony, thank you for being with us as always. Mislav Matejka of JP Morgan writing the following on some of this. It should be increasingly probable that the next months could see some dovish tilt by the Fed. This could act to limit further moves up in long yields. There could be a good entry point for another bouncing growth at present. Tech stocks in particular could do better. Be interested to see if Marko Kolanovic and the team here stateside for JP Morgan echo some of that a little bit later, because this market has gone against their calls in a major, major way. The equity market about 11 or 12 minutes into the session, shaping up as follows. We are just about unchanged on the S&P, just about positive on the NASDAQ by 0.6%. Coming up, the Fed facing criticism from Washington once again as it hurries to tame inflation.
It's going to be hard. It's not going to be easy. There will likely be some job losses. We're going to do all that we can at the Federal Reserve to avoid deep, deep pain.
Senator Warren has things to say. That conversation up next.
somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to work their way up?
Well, I think the first thing you've got to believe in something that you really care about.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, you know, and the ultimate output for a company is share price, you know, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London.
I'm going to be watching retail earnings from both Home Depot and Walmart.
Then surveillance for in-depth analysis.
Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro.
Across the board, these are good numbers.
The big headline there is reaffirming the outlook.
How much does this give faith that you can get some sort of resurgence in consumer spending?
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
It's going to be hard. It's not going to be easy. There will likely be some job losses. There's a really good chance that if we have job losses, it's going to be smaller than what we've seen in other situations. We're going to do all that we can at the Federal Reserve to avoid deep pain, and I think there are some scenarios where that's likely to happen.
Senator Elizabeth Warren taking game of the Fed once again as the central bank moves to tackle inflation, writing in a tweet over the weekend the following. Fed Chair Powell seems determined to push the economy over a cliff, even after he admitted rate hikes won't lower key prices. Destroying jobs and crushing wages of millions of workers is reckless and dangerous. Recession is not the solution to inflation. Emily Wilkins of Bloomberg Government joins us now from D.C. Emily, how alone is Senator Warren? How much company does she have?
John, really, that is the sort of question to ask here. Certainly, Senator Warren has been a critic of the Fed, of Jay Powell. This is not the first time that she's come out and really questioned the strategy that they are doing in rate hikes. She says that obviously some of the reasons that we're seeing inflation have to do with things like COVID, things that the Fed doesn't necessarily have control over. But it's important to note here that we're really seeing kind of her as a bit of a loner in this field as far as really calling out the Fed. Remember, Jay Powell, he got renominated with the support of a strong bipartisan number of senators really backing him here. And so it's clear that he does have the confidence of a lot of Washington, even though he is going to have a couple critics like Senator Elizabeth Warren. But at the same point, it seems like most of D.C. is confident and willing to trust him with these rate hikes that they will eventually lead America's economy to being a little less high on inflation.
Emily, do you sense that that changes if unemployment goes from a 3 handle to 4 to maybe even a 5?
The difficult thing about rising unemployment, particularly for the White House, is that it has been their statistic that they've really clung to, trying to show that Biden has done a good job with the economy. They tend to ignore the inflation number and stick with unemployment. That narrative is going to have to change if you see unemployment rising. Even if that is something where the Fed is trying to prepare people already going out, saying, hey, there's going to be some pain, but it's going to be worth it in the end, the White House is going to have to figure out a way to ride that wave. And if it starts coming in the next month or so, right near the election, that could actually have impacts as far as voters going to the ballot box and voting against the party in power, Democrats.
Couldn't agree more. Emily, it's a complex moment. Emily Wilkins there down in D.C. We've asked this question a million times. How do you convince people that higher unemployment, the loss of your job, is a price worth paying to get inflation lower? That's a very, very difficult job to do, and that may well be this Fed's job to do that job before year end. Complex stuff. Equities right now on the S&P unchanged. On the NASDAQ, we're positive 0.6%. Big week ahead. Ton of Fed speak. Sprinkle of data. Taylor Riggs has more. Hey, Taylor, look, you're back, just like that.
See, I'm
you
allowed
come back
back.
anytime.
This is amazing.
I told you.
I knew that deep down you were so generous,
Big
John.
fan.
Let's take a look at the generosity of this Federal Reserve. As you said, a lot of Fed speak up here, so really going to be hearing from them. We did, of course, you just played a great sound clip, of course, from Raphael Bostic, the Atlanta Fed. He'll be back up on deck around noon. And, of course, in our hours in the closing bell, really focused on Loretta Mester of the Cleveland Fed as well. And that is just today, because if you take a look at the calendar for the rest of the week, yes, it gets busier and busier, talking again about some of the job losses that we heard from Raphael Bostic, but it is necessary, if you believe this Federal Reserve, to bring down inflation. I think, John, for me, what really stood out were the big comments from Jay Powell last week, talking about our message has not changed from Jackson Hole. That is going to be the key here, if they can reiterate that tone as well as we push forward to the rest of the week. Finally, I'll wrap up some of the data for you. Last week, and that's a lie, it wasn't even last week, it was like within the same 24, 48-hour period, G10 central banks had hiked 300 basis points. So this is a U.S. hawkish Fed, but this is a global central bank hawkish narrative underway.
Taylor, for a long, long time, it was our currency, your problem. When do you think this starts to become their problem? These moves are big, big, big moves in foreign exchange.
And take a look at the Mike Wilson note out this morning, talking a lot about the big dollar pressure that is putting on not only the world of equities, but every central banker to the rest of the world. And this is where Jay Powell comes in, as you know, the central banker to the rest of the world, when they really start to think about dollar strength. And is it dollar strength or is it pound weakness? As you know, with currency pairs, it's a little bit of both. Today, it might be more about that pound weakness relative to some of that big dollar strength we've seen.
What a trading range it's been on sterling, and the day still has some hours to go. Taylor, welcome back anytime. You know that. Taylor Riggs, we'll catch up with her later on today and, of course, tomorrow on this program. The Fed speak. It's ridiculous. At the end of the Fed news conference with Chairman Powell last week, I turned to the former Vice Chair, Richard Clarida. If you didn't see it, I turned to him and said, the bad news is that the quiet period for this Fed is over, and he couldn't stop laughing. And I imagine you're finding it quite painful, because you're going to get a ton of Fed speak today. To Taylor's point, you'll hear from the Boston Feds, Susan Collins, you'll hear from Bostic, Logan, Mester. That's just today. And then you'll hear from Evans and Bullard and a whole lot more tomorrow as well. So tons to keep up with. About 21 minutes into the session, talked a little bit about the equity market and where we are at the index level. Let's get you some sector price action. Here's Abby.
It's pretty interesting here at this point, John, because we're up slightly on the S&P 500, reversing a greater than 1% loss in the pre-market. That appears to have to do with that two-year yield coming off of its high, still higher, but not as high as it had been. Now, yields up, that should mean, and it does mean, utilities and real estate, those high dividend yielding sectors, are down. But it should also, in this current environment, mean that the mega cap sectors are down, because valuation becomes a concern. That's not the case. We have consumer discretionary, tech, and communication services on top. The financials, which you would think would get a bid on yields up, this is the conundrum of the year. It is down. Now, over the last 5 days, it's been brutal, as you know, John. If we take a look at the sectors over the last 5 days, big, big declines. Interestingly, the worst sector, though, is energy, down 10%. So this year's up sector, the big up sector, it's down over the last 5 days as oil has tumbled back below $80 per barrel. Today, a little bit higher at this point. But you have also real estate down, discretionary down, materials down, really nowhere to hide. Today's small gain for the S&P 500 right now, up about 0.1%, John, right above that June low, as you were talking about. It's on light volumes. It's going to be interesting to see, of course, how the day plays out.
Abby, thank you. Thank you very much. Talked a lot about the Fed speak. Do you want the ECB speak from Christine Lagarde? Monetary policy has to deliver on its mandate. Fiscal measures, these headlines are fascinating. Fiscal measures can help in tackling inflation. The aid must be targeted, temporary, tailored. Wide fiscal measures are not helping monetary policy. After a decade of asking for it, they're getting it, they're complaining about it. Seeing more wide than tailored fiscal aid right now. The length of volume of any TPI, you know, all that stuff, any buys there will consider inflation. Some assumptions in the ECB forecasts have been overtaken by events. You think? That's ECB President Christine Lagarde. on the tape in the last 10 minutes or so. Coming up, the market moving events you need to be watching. I'll bring you the trading diary in just a moment. In the equity market, about 23 minutes into this session, equities on the S&P up by a little more than 0.1%. And how about that for a bounce back on the Nasdaq? Up by 0.8% on the Nasdaq, even with yields pushing just a little bit higher. From New York, this is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
A little more than 25 minutes into this session this Monday morning. Good morning. Just about positive on the S&P, nicely positive on the Nasdaq, up 0.8%. Unexpected earlier this morning. Given what was happening with the bond market, that faded a little bit as well. 2s, 10s, and 30s. Your 2-year, 12 months ago, something like 27 basis points. Right now, 421. It was pushing through 430 a little bit earlier this morning. We fade that story too. That's the price action. Here's the trading diary. What you need to be watching this week begins with the president speaking at 4 p.m. Eastern time. Then a busy slate of Fed speak with Collins, Bostic, Logan, Mester, all on the agenda later today. Chairman Powell speaking tomorrow morning. ECB President Christine Lagarde speaking again on Wednesday. We get US GDP and initial jobless claims on Thursday. And we round out the week with personal income and spending numbers and the UMich sentiment survey on Friday. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape, the supergrid.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for...
Hello, traders. How are you today? How do you like this market? We like it very much. I'm going to place an order to buy euro. The price I'm looking to buy, 0.9653. So 0.9653. I'm placing an order. And please, if you want to copy this trade, please do so. Otherwise, you can do paper trade. You can watch how we trade, or you can get the strategy. You need to go to company.co.uk to get the strategy, or you can register for webinar. We have so many options for you guys. So order placed. Let's see what's going to happen. Hopefully we will get filled with this order, and I'll speak to you later. I will let you know what's going to happen next. Okay, guys, stay safe.
Or maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police